9 a.m. here in New York City on this Tuesday, October 22nd. Welcome to Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. I'm Shauna Smith alongside Madison Mills, and let's get you the 3 things that you need to know today.
First up, a global sell-off in bonds taking hold as investors rethink their forecast for Fed rate cuts this year. We got the yield on the U.S. 10-year hitting 4.2%. That is the highest level since July.
Plus, the selling continuing, futures lower once again this morning as stocks pull back following 6 straight weeks of gains. Strategists at Citi warning that exposure to the S&P has reached a level that was last followed by a 10% decline in the index.
And earnings season continuing here. We've got results from General Motors, Verizon, GE, RTX, and more reporting this morning as investors prepare for the start of Magnificent Seven results tomorrow. We sat down with the CFO of GM to discuss the company's earnings beat as high prices from its in-demand vehicles offset losses from its growing EV business.
We're picking up share, we're discounting less than most of our competitors, and that's been a consistent theme for the last several quarters. So we're just excited about the momentum we have in the portfolio, not just in our ICE, but also in our electric vehicle portfolio.
Today's morning brief honing in on earnings season and whether big tech can continue to be the market leader ahead of the start of those Magnificent Seven results tomorrow. Let's bring in the author behind today's brief. We've got Yahoo Finance's Josh Schaefer in studio with us. So, Josh, is it going to be all about those 7 names this earnings cycle still?
If you look at the S&P 500 projected earnings growth, right, it is going to be all about those 7 names, right? So, FactSet was out with data last Friday that showed that right now the Mag 7 are projected to grow earnings this quarter 18% year over year. Your 493, so take out NVIDIA, Apple, et cetera, Amazon. The S&P 500 is expected to grow earnings, those 493 are expected to grow earnings 0.1%. So from that perspective, this quarter, once again, when we're talking about S&P 500 earnings growth, to some effect, we're really just talking about the Mag 7. Now, we've been talking about this chart all year long, really, but there's going to be a catch-up, right? This 493 is going to start to catch up, and that has been sort of the case for the broadening trade. But I thought DataTrack's Nick Colas had a very interesting point saying, yes, the 493 are supposed to catch up, but the Mag 7 are still going to grow at about 19% over the next 4 quarters, compared to about 12% for the 493. When you think about that and you think about how reliable big tech earnings have been, he says that maybe makes the case for maybe it's still the big tech trade, especially when you look at the last 2 months of action. The big tech trade hasn't really necessarily been leading.
And even when you take a look, now Netflix is not in the Mag 7, but I bring that up and you brought it up in your piece just because it's the first look that we're really getting at big tech and the outperformance that we've seen, the run-up that we saw prior to earnings, and then obviously this euphoria that's almost swept the street following earnings. Maybe that is a sign of some of that reaction that we could see from some of these Mag 7 names.
Yeah, I mean, you could basically, I think some people would argue maybe you should sub in Netflix instead of Tesla. It might be a better tech name at this point. But yeah, think about what we were talking about headed into Netflix earnings, right? Stock's up 50% this year already. This was prior to earnings. It's trading at an all-time high. Street estimates are pretty high. Can they possibly beat this? We're zooming in on the chart right now. You see that big hook up to the right. The stock took off after earnings because they, again, rose the bar. And I think that was part of the point I was making in this piece this morning is if you were thinking over the last 18 months what companies are going to continue to surprise to the upside, it's been these 7 companies. It's been big tech. So to make that argument, at least at this point in time, doesn't necessarily, at least to me, feel like that big of a reach. That's been the market story. If you told me that NVIDIA is going to come out and beat street estimates again, that's not necessarily shocking. The question is, with them trading at an all-time high right now, Apple's at an all-time high, is some of that maybe catch-up trade already starting to be baked in over the last week or two? I think maybe that's another side of this argument that people could start to make with it.
You can check out Josh's morning brief on yahoofinance.com and then, of course, subscribe to the newsletter as well. All right, Josh, great stuff. Thanks so much. Meanwhile, investors are grappling with a sell-off in global bonds as traders rethink the Fed's path for rate cuts. The U.S. 10-year yield touching its highest level since July earlier today as the selling continues. Joining us now, we want to bring in Gargi Chowdhury, Chief Investment and Portfolio Strategist at BlackRock Americas. And Gargi, it's great to have you back here on Yahoo Finance with us. Let's start with this move that we have seen in the bond market, because that's really the focus here this morning. We've seen a sell-off in bonds. We've seen the yields obviously move to the upside. I'm curious just your assessment of almost the shift in thinking and the narrative that we're seeing play out on Wall Street.
Sure thing. Good morning. It's great to be here. And thank you for having me once again. So absolutely the move, not just this morning, but over the course of the last month or so, in especially the long end of the bond market has certainly been something that investors have been focused on. And particularly what I tend to look at is how much of the move in 10-year nominal rates coming from real rates and then expectations of inflations, right? As what we're finding now is that, yes, real rates have certainly moved higher. So we've sort of moved up from that 160 level to about the 190 or so level. But at the same time, expectations of inflation or 10-year break-evens have also moved wider. So the backdrop here is an economy that, depending on whether you look at the labor market data, whether you look at retail sales data, you're seeing an economy that continues to surprise to the upside. If you look at that GDP, Atlanta Fed Now GDP forecast, that's continuing to move higher. And at the same time, your expectation of inflation remaining a little bit more sticky is something that probably the bond market's pricing in. We've long believed that investors should focus on the belly of the curve, so really keeping their duration around that 3 to 5 year part of the curve rather than the very long end. Because, as we point out in our investment directions for Q4, we still do expect that steepening to continue to take place.
So, Gargi, there's been a lot of talk about the Trump trade this week in relation to the bond sell-off that we've seen. Is it your view that any of this is tied to an idea of the market pricing in a Trump win?
I think, as I pointed out, I think we've seen a lot of reasons, a lot of good reasons that the bond markets have priced in recently. Part of that is the expectation of growth. That is certainly one of the drivers of especially the long end of the bond market. Higher growth is certainly going to always be commensurate with somewhat higher expectations of real rates, and that's exactly what we're seeing in the markets right now. I would also say that regardless of who's in the White House come 2025, one of the things that we've been talking about with our clients is just this expectation, unfortunately, of rising deficits. So deficits as a percentage of GDP is something that obviously we focus on, you focus on. And regardless of who's in the White House, that is something that's probably not going to come down. And again, that is something that the bond markets perhaps is sniffing out a little bit. And perhaps that's what is leading to some of this steepening and certainly some of the bear steepening that we've seen in recent days. But let's be clear, it's certainly also related to the expectation of better growth in the quarters to come that is in the price right now.
Gargi, I guess from an equity perspective, how should investors then be looking at this dramatic, I guess we can call it a dramatic move higher in yields? There have been some, maybe the more appropriate way to phrase this is there's been some more dramatic calls out just in terms of how high that 10-year yield could potentially climb between now and year end. I guess at what level does this become more of a challenge, more of a risk here for the equity market?
That's such an important question and absolutely the right one that we should be asking. If we can even think back to the beginning of this year and even the beginning of 2023, one of the most marvelous things that we saw in the equity markets was especially the quality parts of the equity markets, those companies that are symbolized by high earnings growth, very high levels of cash flow. We look at the ticker QUAL as a measure of quality. If you looked at those quality companies, they tended to do well despite a higher rate environment or a lower rate environment. Regardless of either, quality did well, tech did well. I think that if, obviously, barring a very sharp, steep move, significantly higher in rates, which I think can impact all equities, but I think a gradual move higher, again, and I underline this, for the right reasons, with the expectation of higher growth, can actually tend to be, or historically has tended to be good, again, for those earnings growers. So keeping quality at the core of your portfolio remains really important, we think. And then gravitating a little, especially now, I was listening to your program earlier, looking at earnings season, we think value can have its moment. We're focusing on large cap value in particular. BLCV is a ticker that we like that focuses on some of those areas, financials, healthcare, that are, we think, going to continue to have really strong earnings growth.
Gargi, it makes me wonder about that note from Citi we talked about earlier in the show, the idea that exposure to the S&P is at record levels, and that's typically followed by a potential 10% slump here. In your view, based on what you just said, then, could earnings growth and quality outweigh any exposure concerns?
Look, I think one of the things that we all have to remember is the incredible amounts of cash that's sitting on the sidelines right now. So if you look at least in the US, if you look at the numbers right now, it's somewhere around 6.6 trillion. Can we continue to see markets go up in a straight line? No, pullbacks can be healthy. Pullbacks can be welcome, especially when you have that money on the sidelines that is now, especially after the start of a cutting cycle, looking for opportunities to get invested. So markets don't go up in a straight line. We have a big volatility event coming our way in exactly 2 weeks. We might not know the result of the elections for a couple of days. That could induce some volatility in the market. We certainly are talking to clients that are looking to find ways to hedge their portfolio against volatility using things like gold or buffered products. I just think that we have to remember that this is an economy that there's a lot of positive things that are going on. We have strong earnings growth. We have revised higher GDP expectations. We have a cutting cycle in place. Those are the things that are going to support quality parts and for at least the next couple of months, value parts in the large cap part of equity market in the next couple of months. And hopefully, even if there's volatility, those will create some opportunities for investors to deploy cash from the sidelines.
A healthy dose of optimism to kick off our show today, Gargi. Thank you so much, as always, for joining us. Appreciate it. Gargi Chaudhary over at BlackRock. Appreciate it. Well, General Motors beating Wall Street's expectations in its third quarter and raising its full-year guidance. Our very own Brian Sozzi spoke to GM CFO Paul Jacobson about the latest results and the outlook for the EV market.
It's really a testament to the product portfolio that we built, and the entire team here at GM deserves a lot of credit for that. We're building vehicles that customers are flocking to. We're picking up share. We're discounting less than most of our competitors, and that's been a consistent theme for the last several quarters. So we're just excited about the momentum we have in the portfolio, not just in our ICE, but also in our electric vehicle portfolio, and what we're building there as well. So I think there's a lot of things that are going for us, but most importantly, it's keeping the customer at the front and center of everything that we do.
Has the Fed's rate cut started to positively influence a company like General Motors, whether it's on the debt side or of course, whether it's on the demand side?
Well, demand's been fairly steady for us all along, and you've seen that consistently in our results. What I would say is that, affordability has become more and more of a concern over the last couple of years as inflation has taken its toll on the consumer. So, certainly reductions in interest rates are going to help that with monthly car payments and helping consumers with that monthly bill. So we expect that can be some momentum for us as we head into 2025 with the expectation of lower rates, but it really starts and ends with the portfolio and what we're building for our customers. You
called out an important word there, Paul, in terms of affordability. I sense that GM is really leaning into that. As you look out over the next 12 months, what are some of the price points in your vehicles going to be, and why do you think consumers are so cautious?
Well, we've probably been a little bit more stable in pricing than we have been in years past, but we're still enjoying some price benefits as we lap last year's actions. But when you look at our portfolio, we have everything from the Cadillac Escalade to the new Corvette ZR1 that I know you're probably excited about, all the way to the Trax and to the Buick Envista Encore GX. We've got really a vehicle portfolio for everybody. So when you look at the Trax starting with an MSRP right around $20,000. It's a great vehicle. We actually bought one for my daughter to drive out in California. So it's one that consumers are really flocking to. We've seen a lot of sales momentum in that. And when you look at all the refreshes of the vehicles that we've brought out, the important thing financially is that they're all more profitable and come in at higher margins than what their predecessor vehicles were. So the team is really taking to heart driving efficiency while still building a quality portfolio across all price ranges for our customers, and that's really paying off for us.
Paul, you got her a Trax and not a ZR1? What's up with that?
I don't think my wife would trust me in a ZR1, let alone my daughter.
Okay, just had to ask that very tough follow-up. But I think one of the interesting things, and you touched upon it at your Investor Day a couple weeks ago, it seems like the new models that you're flowing into dealer lots are, notably the SUVs, are more profitable than what's going out. To the extent you could, how are you doing that?
Well, there's a lot of work going on with material cost reductions. You know, we talked about an effort being led by Mark Royce and our product development team we call Winning with Simplicity. We've eliminated almost 2,500 part numbers from the portfolio, and we're just getting started in terms of driving efficiency through the portfolio. That's what we're going to need to be competitive in the long run, and we need to do that for our customers as well.
When you say parts, I mean, so I will get into a new GM SUV and maybe there's a less button. Is it as simple as that and then doing that at scale?
A lot of it is behind the scenes, combining some parts into multiple vehicles and using that sharing that's out there, but making sure that we do it with the customer in mind, because what we don't want to do is start cutting customer features and making our vehicles less desirable in the customer's mind. So it's really a highly technical effort behind the scenes, and those things that the vehicle can work every bit as well as it could before, but still have the same features, and in some cases even more. Because we're able to invest in those things that matter to the customer.
Also technical and no small feat in doing is it seems like you're really focused on driving down inventory. By the end of the year, how many days inventory you will have on hand, and how does that free up cash for the business to be spent back on buybacks?
So we've been keeping inventory discipline pretty constant for the last few years. Our target is to have between 50 and 60 days on hand at the end of the year. We ended the quarter with about 68, but we have to build going into what is really a kind of a peak selling season in the fourth quarter. We get a lot of pickup. We also have fewer production days due to the holidays. So we built that up, but we expect to be down in that 50 to 60 day range as we get into the end of this year. And that puts us on firm footing to start next year right where we need to be. But what it does is it frees up a lot of working capital for us and make sure that we're focused on getting the right vehicles to the right dealers in the hands of the right customers at the right time.
All right, do stick around. Much more coming up on Yahoo Finance.
You're watching Morning Brief, brought to you by Invesco. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, SAP lifting its 2024 outlook as cloud revenue soars. The German software company beating third quarter expectations as it increases its AI services. You can see those shares in the extended trade here up over 3%. And it's interesting given that SAP based in Germany, the German economy is in deflationary territory, really struggling here, but SAP managing to have a stronger GDP forecast than the broader nation of companies there. Having said that, also getting back to the cloud story here, Shauna, it's interesting. They reflect sales booked over the next 12 months are up 25%. That is a huge gain.
Yeah, and I think we're seeing some of that excitement about that guidance, right, play out in the market here today, why we're seeing such a huge jump in terms of the biggest intraday jump that we've seen since July, I believe is what you just said. Yeah. So when it comes to their transition and what they've been doing, implementing more AI tools, helping that drive their cloud sales, it's certainly paying off. But as you can see, and you take a look at a longer term chart here, we've got the 1 month up on the board showing that sales have essentially been flat here. But again, when you take a look at some of the guidance, year to date, it's still up about 48%. So we talk about the transition here within SAP, and some of investors reading through it is exactly how they are capitalizing on that AI demand and repositioning their business in order to further do that going forward. We are starting to see that play out, and certainly in real time, and on the heels of this earnings report and the pre-market action that we are seeing with shares up just about 3% now, continuing that move to the upside.
And quick mention here, the CEO this morning on a call with journalists saying about 30% of their cloud deals dealt with AI use cases in their business offerings. So I think that's a potential leading indicator of what we might see from other companies of use cases within AI here.
All right, let's talk about Sherwin-Williams. Sherwin-Williams missing third quarter earnings expectations. The paint maker noting weak demand for the do-it-yourself market that weighed on sales. Still, the company reiterating profit growth expectations for 2024, yet you're still looking at shares. Didn't do much to placate some of those concerns. Still off just about 4%. Let's talk about what is in this report, because like we just said, the do-it-yourself paint market, that weighed on sales of the consumer branded paint, but residential paint sales rising the mid-single digits despite that down market that we've been seeing, and putting it in the executive words here from Sherwin-Williams of construction and property here. But again, some of that softness, maybe you can read into that people are pulling back on their spending, not as willing maybe to spend on some of those items right now to improve their home. It will be interesting once we get a better picture following this earnings season. But again, this is a reading on the consumer, showing where consumers are willing to spend their money. And obviously, we're looking at some weakness here for Sherwin-Williams.
Right. Maybe as we were just bantering about in the break, your significant other isn't letting you paint the house over again because of the economic headwinds that we are all experiencing here, which is really unfortunate for me. But it is, it's a macro story. It's a story about the housing slowdown. It's a story about people who have already kind of redone their homes during the belly of the pandemic, and now they're maybe not doing that as much. I thought it was interesting. They talked about how they're able to control their internal administration costs as something that could be a positive moving forward. It kind of feels like when you're mentioning the SG&A, the selling general admin costs, you're maybe grasping at straws just a little bit for something positive to point out on the call. Having said that, here you can see the stock up over 22% year to date. All right, finally, 3M beating third quarter expectations, even as sales fell more than 21% year over year. The company raising the lower end of its full year adjusted profit forecast, expecting Fed rate cuts to help boost consumer spending. You can see here the stock up over 4%. And it's important to note that this is the second full year profit target increase under their latest CEO. So a huge positive lift here when it comes to the optimism surrounding this name. The CEO, Bill Brown, he started back in May. So this is the second time in kind of a short time period that they have been able to lift that profit target. I also want to mention the operating margins up 23% year over year. So huge gain when it comes to that.
Yeah, huge gain. You talk about outperformance since he's taken the helm back in May. That stock is up just about 40% since he became CEO. Also something that was interesting that he pointed out, Bill Brown, in terms of some of the trends that they're seeing or strategies that they're implementing or really focusing on while he is at the helm. He talks about on-time and in-full delivery of products. This quarter, that reached 89%. Why that is so significant is it's a 5 percentage point improvement since the start of the year. And he went on to say that we all recognize that we've lost business to competitors because we didn't have the right product ready to go. So he is re-strategizing some of their internal workings right now, and it looks like in terms of what he has implemented and that turnaround strategy going forward, it certainly has paid off. Investors believe in that narrative, in that story. You can clearly see that by the uptick that we've seen since he did become a CEO back in May. And again, that trajectory here to the upside. Keep right here on Yahoo Finance. We got much more of your market action ahead. Just about 4 minutes until the opening bell. We'll be right back.
We're heading closer to that opening bell on Wall Street, and you're watching Morning Brief brought to you by Invesco. I want to do a quick check of the markets here. I'm going to flip the board over to what we're seeing in terms of futures while we wait for that opening bell here. You can see still a little bit of a risk-off sentiment hitting the market here, and let me switch over to the intraday board. So you've got the NASDAQ still under pressure this morning, the Dow also under pressure alongside the S&P. But of course, the big story for the day is what we're seeing in the bond market, that global sell-off leading to some questions about whether or not central banks globally have really kicked off a rate cut cycle, or if they maybe went a little bit too quick, too fast in terms of the market pricing getting a bit over its skis. Here we've got that opening bell on Wall Street. You're looking at the New York Stock Exchange and the NASDAQ here. Taking a look at what we are seeing in the markets, I'm going to give us a second to have the boards just now that the market is open. It's interesting, too. I just want to mention the pressure that we're seeing in small caps. You would think that after a rate cutting cycle gets kicked off, you would see a little bit of a lift to the upside in small caps, but that's not what we saw yesterday. It looks like you've still got pressure on the S&P and the Dow, but the NASDAQ flipping into positive territory here. All right, let's get over to Yahoo Finance's Jared Blickery for a broader look at what is moving markets so far today. Hey, Jared.
Hey there, Maddie. Yeah, I was just talking about the small cap underperformance yesterday with Callie Cox. This has been an unusual bull market that just turned 2 years old. But first, let me just focus on what's happening with the NASDAQ. It looks like, well, it was up 4 days, and it looks like it might be going for a fifth or snapping that streak. I don't think we've had that first quote just yet, so don't read too much into that green on your screen. But what I want to show you, again, is a 10-year T-note yield. Thank you, Maddie, for highlighting that, because that was a big day yesterday. This is going to be a year-to-date look, and you can see it has climbed quite a bit off of those September lows. It was actually normal per history to get a little bit of a rise when the Fed finally starts cutting rates, even though that may seem a little bit counterintuitive. But I've been assured that that is the case, at least on a short-term basis. But we don't want to see that continue too far, because you take a look at the U.S. dollar index, which has been heading higher as well. That's at the 200-day moving average. You want to, if it crosses over that along with the 10-year, that just spells more trouble potentially for equities. Now, we got to take a look at the sector action. Energy is the only one in the green. It looks like Staples trying to turn green as well. Cyclical sectors, a little bit of pressure for them. Consumer discretionary, and now tech and communication services. So the Mag 7 sectors are the ones that are most under pressure, and just a little bit of pressure for the cyclicals. I'm going to go to the NASDAQ 100. Both NVIDIA and Apple have been hitting record highs recently, but you're going to see a lot of red here. Not today. Apple's down over 1%, so is NVIDIA. Alphabet just barely clinging to some green there, and Microsoft as well, but not a whole lot of upside action for these issues. And then got to hit futures, because silver has been on a tear, hitting another high, the highest since 2012. And if I put a 20-year chart here, you can see how it has been climbing to these levels that we haven't seen since the aftermath of the global financial crisis. And that high back in the day on an intraday basis was right around 50. So got a ways to go. 34.74 is the last print here. Finally, I want to close with Ethereum. Been tracking Bitcoin, and we can see a bit of a red there. But here's Ethereum, and there is a pattern that is getting some attention among traders: inverse head and shoulders. And Peter Brandt is the one I saw on X that was actually highlighting this. Point is, if it is able to climb out of this pattern, we got a measured move all the way up to what, 3,500 perhaps. So bulls in the crypto space looking to Ethereum perhaps as the next trigger. Guys?
All right, we will see. Jared Blickery, thanks so much for breaking that down. Well, following the blowout September jobs report, swaps are now only pricing in 39 basis points of cuts between the Fed's final 2 meetings of the year, with less than a quarter priced in for the November FOMC meeting. So is the Fed's rate cutting cycle on hold? Let's discuss with Ben Emmons. He's the FedWatch Advisor's Chief Investment Officer. Ben, it's great to have you here. So let's talk about maybe this shift that we've been seeing in terms of the pricing of what investors and what traders are expecting to see over the next couple of meetings from the Fed. Do you think the argument that the Fed is going to remain on hold, does that make sense given what we know?
Actually, it does not, Shannon, because if you listen carefully to Mary Daly last night, she actually voices the view within the Fed of why these rate cuts are needed. Right? They want to build an insurance to make sure that the unemployment rate doesn't move away from them, actually doesn't meet their forecast, which they have set at 4.4% by the end of the year. And we're currently roughly about 4.1, right? So they are clearly concerned that the labor market has some form of deterioration, and they want to prevent that from getting worse. So in that sense, this Fed is not in a mode here to say, hey, we'll put everything on hold. Of course, they can skip a meeting. That's always been the case, even during tightening cycles. But what I think they're assessing is that we gave the economy kind of a push with this 50 basis point cut. We're seeing the numbers start to play out. If we're right, then we can continue to cut, but maybe at a slower pace. And I think that's what the market is pricing. If you look at the number of cuts now priced into March of next year, there's about 3. It was about 5 just after the FOMC meeting, about 8 before the FOMC meeting. So you can clearly see the change there. And I think that is what's driving the 10-year yield higher. So it's really the Fed that wants to keep cutting, but the market assessing, you can do this probably somewhat slower from here while you guard for this labor market.
Well, given that, Ben, I'm curious. We know that credit spreads are tight. We've got consumer spending still remaining strong, and the labor market, at least for now, looking okay. Is there a risk there of reinflation?
I think there is, Maddie, but I think it also depends much on what's happening with geopolitically in the Gulf region in particular. You know, what happened with Israel sort of taking control in the war of Gaza and not attacking the Iran facilities just yet. I think that's what we have to watch, because if anything of that changes, I think that's more your inflationary impulse to markets overall, as opposed to this idea of like, yes, we're giving the economy some acceleration with this rate cut, but we also did this through the equity markets and loosening of financial conditions. But it's really to keep the economy actually on track, as opposed to letting it weaken further in order to get, you know, our outcome of 2% inflation. So you want to watch what's happening with commodity prices, really. I think if we're getting more turn higher there, which, you know, may happen, or some sort of exogenous shock, then that would drive inflation expectations, as opposed to the Fed themselves, which, you know, for all their purposes, they remain reserved, right? They just want to go slower in that tempo.
Ben, is that the most important, not so much indicator, but trade to watch then ahead of the next Fed meeting?
Yeah, I do think it is, because, you know, ultimately, I think what markets are looking at is that we currently are what it feels strange, but we're like in a totally certain environment, meaning the markets don't see much tail risks, neither do they see any kind of election outcome uncertainty. In fact, there's a view in the markets that this Republican Congress is actually going to happen, and then whomever will be president, you know, Republican Congress will drive forward all these measures that people are looking at to price into the markets, as in lower corporate tax rates, more reshoring, and these tariffs basically trying to balance the budget. So I think it's really that aspect of certainty in markets that is the indicator against the commodity markets that are potentially at risk of a flare-up of geopolitics.
I want to talk about what we're seeing in the dollar, because we're seeing some speculation and some trimming of dollar shorts ahead of the election. But I wonder if we could see the opposite, particularly if we do get a bear steepener. Could we potentially see, and because dollars are at such high levels at the moment, could we see a potential weakness on the dollar on the heels of that election?
I think it matters of more how the dollar will weaken what the economy ultimately does. You know, let's say that this bear steepening, which means that long-term rates rise more than short-term rates, that really starts to affect the economy again negatively. I think that's when the dollar will turn from the strength to weakness. Because as so far as we've seen, the dollar has been strengthening as these rate cuts are somewhat priced out, but it's really the acceleration that started early August in ISM data and other PMI data that's coming through now. And you see this morning, another regional manufacturing data is stronger, that lifts the dollars. Really, the dollar's kind of trading on the economy. So if higher rates and bear steepening eventually slow the economy again, I could see that dollar weaker. I'm not so sure if this has anything to do with the election in itself, because we know the deficits will stay large, and the dollar hasn't responded much to that at this moment. It's really about the economy, I think, where the dollar ultimately heads to. Looks to me, the economy's strong, dollar stays strong.
All right, Ben, we got to leave it there. Really appreciate you joining us this morning. Thanks so much.
Thank you.
Coming up, Tesla's third quarter earnings on deck here. We're going to break down the biggest things investors should be watching out for next, right here on Morning Brief. You're watching Morning Brief, brought to you by Invesco. We're taking a closer look at some of our trending tickers this morning, and we're going to do it in 30 seconds each, so get the timers out and let's get started. First up here, Lucid shares in the green. The EV maker's CEO saying that the street misinterpreted its $1.75 billion stock sale that was announced last week, clarifying that it was meant to provide a cash runway into 2026. The sale, along with announcing a bigger quarterly loss than expected, sent the stock plunging last week. You can see the shares up following this announcement from the CEO today. Having said that, Wall Street analysts did take a negative view on the sale, saying that it was earlier and larger than anticipated. Specifically, that came out of Morgan Stanley here. So differing views from Wall Street and the CEO on that one.
All right, Maddie, let's stick with the auto theme and switch gears here to Honda because shares are sliding. The car maker recalling over 700,000 cars in the U.S., and this time over concerns of a faulty fuel pump. That's according to the National Highway Traffic Safety Administration. We're looking at share pressure just a bit here, off just about 0.7%. The significance of this, though, it's the second major recall for Honda just this month. So again, when you take into account the fact that this is the second major recall at Honda after 1.7 million vehicles were found to have potential steering issues earlier this month, just another black eye or potential headwind here for this stock then going forward. Let's stick with autos and talk Tesla. Tesla's third quarter earnings results are due out tomorrow after the closing bell. And investors are looking for more insight into the company after its recent robotaxi event might have failed to impress just a bit. Joining us now, we want to bring in Stephen Gengaro. He is Stifel's next-gen transport analyst. And Stephen, there's a lot riding on this report in many regards. It'll be the first Mag 7 stock to report earnings, and obviously lots of pressure on Tesla following that robo-taxi event. I'm curious, what is the number one thing that you will be watching for, the most important thing to be watching for in this report?
Thanks. Good morning, and thanks for having me. So to me, the most important thing to look at is going to be on the vehicle side, the gross profit per fleet, per asset. You know, the shipment volumes that they already disclosed were up about 6% year over year, and that was after declines in both the first and second quarter. So that trend was positive, up about 4% sequentially. Now, part of that is pricing and financing incentives that Tesla has laid out. So after seeing gross profit per vehicle decline over the last several quarters, I think some level of stabilization in that metric will be, I think, the most important thing to watch when they report earnings tomorrow night.
And there's also a lot of optimism from investors about the full self-driving capabilities. What can investors look at, either within the earnings statement, on the balance sheet, to kind of suss out the viability of that as a revenue driver moving forward? The robo-taxi event, I think if there was something that came out of it which was disappointing was the detail around full self-driving, because clearly full self-driving is a critical element to getting to a robo-taxi. I think incremental details on FSD and the traction they're having there is important. I'm not so sure how much we'll actually get on the conference call tomorrow night, especially following the recent robo-taxi event. But I think there's clearly a divide on Wall Street between whether the camera-based, AI-based system that Tesla's using for full self-driving will be adequate to get them to the finish line on FSD. And when we think about, our target price for the stock, we do include full self-driving and robotaxi, but in a long-term perspective, right? We're looking at 2028 to 2035 for contribution from FSD, and then robotaxi closer to the mid-2030s. So it's really any incremental details on progress behind FSD that would be critical on that front.
So then, Stephen, what is the street missing? Is it that long-term view, just in terms of trying to explain this massive sell-off that we've seen since the event? And even just going beyond that, you have shares over the last month that are still down about 13%.
Yeah, I mean, the stock did run up into the event before that, so I think that was part of it. When we think about our valuation on Tesla, we have a $265 target price. A little bit under $200 of that is sort of the core auto business, and then solar business, and the storage business. The FSD piece and the robotaxi piece, that's incremental to that kind of high 190s to get to that 265 level. And it is a stock that you have to have a vision on, right? If you're buying this stock because it's an automaker near term, you're going to think the stock's overvalued. So you're going to get fluctuations in the stock around data points on both the auto side and on the FSD side. But to own the stock and our buy rating on the stock is really driven by the fact that we think you'll see traction on these two fronts. And we think that ultimately is where an enormous amount of value in Tesla will get unlocked. But short term, you are going to see volatility like we've seen recently, simply around data points.
And I'm curious here, Stephen, GM this morning reporting earnings, talking about how they are close to generating profits on their electric vehicle side of the business. Is that a headwind for Tesla, either short or long term?
It's an interesting point. And first, Tesla generates a lot of money right now from regulatory credits. And they're selling regulatory credits to legacy OEMs who have sort of lagged in EV development. So that's one area where Tesla has benefited in the short term. The other delays we've seen kind of across the spectrum from GM and Ford and others, it really allows the Tesla and the Rivians of the world to continue to gain traction with customers. So I think that actually sets them up for being in a very good, strong position longer term. The customer sentiment, it's interesting around sort of brand loyalty historically. It's been disrupted by the Teslas of the world. And it's going to be interesting how this evolves as to whether sort of a legacy GM person will actually is going to go to Tesla or Rivian over GM. But I still think that the Teslas and Rivians of the world are kind of leading the way on the EV front. So I don't think those GM comments have too big an impact on Tesla in the next couple of years.
All right, Stephen, thanks so much for joining us. Appreciate it.
Thank you.
Peloton stationary bikes will soon sell at Costco stores and on its website as the troubled fitness company is looking for new ways to reach younger and more affluent customers. The company announcing this news today. Under the terms of the deal, Costco will offer Peloton's Bike Plus in 300 of its U.S. stores for $1,999. That's a steep discount from the typical price of that bike. It's selling on Peloton's website now for $2,495. You can see the stock up over 1.5% at the moment. I think it's an interesting deal, though, Shauna, especially targeting younger customers with this discount to the tune of about $500 here. That's a really kind of potentially good reason for customers to get into a Costco and get this Peloton bike.
It is good reason, and I think it also just shows the strategy here that we have seen a strategy shift for Peloton. For a long time, it was growth at all costs, and we've seen much more of a focus on profitability. We know that their former CEO, Barry McCarthy, did step down earlier this year. And this pivot that we are seeing right now, Peloton's being led by two board members here. This pivot that we have seen, I think, really shows the fact that they are trying to do all they can to attract new customers. And they're trying to do it in a smart way, in a way that makes a lot of sense for their cost-cutting strategy. And you would think a partnership with Costco does exactly that. It is important to point out that this is only for a limited time, and Peloton saying that that is the case because fitness is a seasonal category for the company, but they do in fact hope to keep building on this relationship and perhaps extend it to more stores as well, and even talks of going international as well. But again, this is a step here for Peloton, and what has been talked about is they are trying to do everything they can to attract new customers, something that has proven pretty difficult for them to do.
Absolutely, yeah.
All right, keep it right here on Yahoo Finance. Coming up next, the NBA regular season. It starts today. More on the league's partnership with Nike and where to watch the games next on Morning Brief.
Nike announcing this week they're extending their partnership with the NBA and WNBA for another 12 seasons. The announcement coming a week after the company's new CEO, Elliott Hill, stepped into the role, beginning a long-awaited turnaround push for the company. We also have the regular NBA season set to open tonight. So here to discuss, we are joined by Yahoo Finance's Alexandra Canal and Brooke DePalma. Brooke, I want to kick it off with you because you attended an event yesterday. Elliott Hill was there. A slew of NBA people were there. Talk to me about what you learned and what the biggest takeaway was for you.
Yeah, this was really Elliott Hill's first big splash as the CEO one weekend, but it really speaks volumes to Nike doubling down on athletes and consumers at the core of the business here. This 12-year extension agreement makes Nike the ongoing exclusive partner when it comes to uniforms, apparel, and fan apparel. Nike really ensuring here that it continues to be a part of culture. And at the event, Elliott said that if they put the athlete and the consumer at the center of everything that they do, they'll come up with new and interesting ways to celebrate the game, help grow the game, even internationally, and moving beyond just on court to lifestyle and the culture of basketball. And as you noted, there was a slew of NBA champions there. Kevin Durant, WNBA champion Sabrina Ionescu, even Caitlin Clark made a virtual appearance. And it really speaks volumes to the intersection of sports, fashion, and music that Nike is really looking to get at right now and become a part of conversation, but investors still really doubling down on what that turnaround will be here. Shares down nearly 6% in the last month alone. They posted first quarter earnings report that missed revenue, beat expectations, and on the call, the CFO, Matthew Friend, saying that this comeback of this scale doesn't, in fact, take time.
Yeah, it does, in fact, take time, and it's something we've also heard from a number of analysts, too, here, Brooke, ever since we did get the announcement of the new CEO and since Elliott Hill did take over. Allie, let's talk about the NBA season, right? Because there's been so much talk, and you've been covering it so well, just about the rights and how that played out. And it's not so much affecting this season, but what do you think it more tells us just about that relationship here with the NBA, with professional sports, and some of these streamers and traditional TV networks going forward?
Well, this is the last year you're going to be able to watch NBA games on TNT Network, which is owned by Warner Brothers Discovery. Now, Warner Brothers Discovery has sued the NBA over the loss of the rights that kick into effect next season. The NBA filed a motion to dismiss that lawsuit, but we're still tied up in court there. So presumably, this is the last year that you can watch those games on TNT. Instead, we have two newcomers, Amazon Prime Video, along with Comcast, NBC Universal. Disney, which is the current league's partner, along with WBD, they were able to renew that agreement. And I think it speaks to the point that these streamers, these tech companies, they really want to be involved with these professional sports leagues. You're seeing the same thing play out with the NBA, with the NFL as well. Now, Amazon was able to strike a partnership worth a reported $1.9 billion. The package includes both regular season and playoff games, plus a play-in tournament and a share of conference finals, which will rotate between partners. NBC Universal, they coughed up a reported $2.5 billion, and Disney, they actually upped their payment from $1.5 billion a year to $2.6 billion. So again, just the amount of money that's floating around and the fact that sports is really the last frontier for media at large, and especially these streaming companies that are trying to get eyeballs on their platform.
Yeah, how critical it is for that future growth. All right, Allie, great stuff. Thanks so much. And of course, thanks to you, Brooke, as well. And a programming note, tune into our new podcast, Yahoo Finance Sports Report, hosted by Joe Pompliano, where we will be breaking down the financial side of the game for your financial gain. Catch new episodes Thursday on your favorite podcast and streaming platforms. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, global bonds selling off as traders reassess expectations on the Fed's rate path moving forward. We'll bring you the latest on those moves.
Plus, U.S. stocks declining for a second day in a row as Citi strategists warn that exposure to the S&P 500 has reached levels that were followed by a 10% slump in the past. We've got more on that ahead.
And the IMF out with its World Economic Outlook. We're going to go live to Washington to discuss the findings with its chief economist at the IMF and World Bank annual meetings in D.C.
Stocks could be headed for a steep slump. That's according to Citi strategists. Now, in a new note, the team writing that exposure to the S&P 500 has reached levels historically followed by a 10% drop. Strategists noting that they're not suggesting investors should start reducing their exposure, but cautioning that increasing positioning risks when the market is extended. Last year, the S&P fell, falling more than 10% between August and October as investors worried that the Fed would keep rates elevated for a longer period of time. In order to do that, they were doing that at that time to combat inflation. So here we are at this time, and we certainly have seen the narrative maybe shift just a little bit in terms of the timing of the expectations of rate cuts. We certainly have seen that play out, especially in the moves here over the last 24 hours or so within the bond market. But I think what the Citi is really calling into question is taking a more historical view of where we are right now, the exposure that we are seeing to the S&P, and just warning that last time we saw this, we did see a 10% pullback, and how this setup compares to when we were last making or having these discussions.
Absolutely, Sean. And it's interesting that they call that out, but they also say, hold your horses, guys. We're not saying reduce your exposure, but we are just pointing out the risks here. And those positioning risks rise when markets get extended like this. They do note, however, though, that investors and accumulated large profits, whereas current P&Ls are positive, but by no means stretched. So I think that's an important thing to point out here. And they talk about, we've got that soft landing potentially on the table here. We've got earnings support moving forward. So the bullish momentum could also potentially continue. It'll certainly be interesting to see whether or not these recent semi-bearish tones that we're getting in notes continue as we get closer to the end of the year. All right, well, the current pullback seen across major averages spurred by investors recalibrating the outlook for Fed policy. But a crowded week of earnings could bring plenty of future market catalysts. We've got the Mag 7 member Tesla set to report tomorrow. For more on this, we are joined by Kenny Polcari, Slatestone Wealth's chief market strategist. Kenny, great to speak with you.
Thank you for having me.
Being here.
Always a pleasure to come.
So is the Mag 7, this is so boring, but is it going to be
So listen,
the saver of the market?
To the point, just what we've been talking about, right? Is the market stretched? Sure, it's stretched. Should it pull back? Of course it should pull back. I'm actually, as a chief market strategist and a wealth manager, I want to see the market pull back because I can't put money to work exactly to the point. I don't want to chase stretched names and stretched sectors, right? So I'm actually waiting for the market to pull back. It should have, the September to October timeframe is really the time that it does that. They've managed to prevent the market from really pulling back. I think the Fed is kind of responsible for that because I don't think they wanted a lot of chaos going into this contentious election. So I think that one less thing they needed. But I do suspect that we will see a pullback, and I welcome it. Now, the Mag 7, I think AI is going to absolutely continue to crush it. Dan Ives from Wedbush came out with a great report the other day talking about now the second derivative of AI, right? So you're going to take just away from the Mag 7, you're going to start to think about the other names down the list. So Cisco, SAP, IBM, Oracle are all names that he thinks are going to start to join, in this tech boom. I agree with him. I think tech is the place to be. I don't say you should chase it up here. Let it pull back and then jump in.
Yeah, we certainly are seeing some of that excitement play out this morning on the heels of the SAP's quarterly results. But Kenny, I guess how much of this hinges on the Fed still cutting? Because I know you do remain optimistic about that.
Yeah. So here's the deal. I think the Fed was too aggressive in September. I was in the camp that they should have gone 25 basis point moves. Not really sure that the economy was necessarily as weak as they thought. Then, and I think that's what they had prepared the market for. Yeah. And then they went into the quiet period, and suddenly, the Wall Street Journal publishes that story, and Goldman Sachs comes out with a breaking report. And, that's the way they leaked the story out to the market, that they changed their mind. And so, in fact, they did. They cut 50 basis points, and Jay Powell came out and said, well, we're concerned about the labor market. In fact, the data shows that the labor market is not nearly as weak as he suggested. So now, I think the Fed's in a position where maybe they do nothing in November. And I think the market has to just get used to that because, you know, they talked about a fairly aggressive rate cutting schedule, something that I never agreed with because I don't think the economy is as necessarily weak as they say. And by the way, they're going to cut rates 50 basis points, 75 basis points. It's not going to bring down the price of chicken and steak and eggs and milk. The only thing that's going to do that is if they let us go into a recession, and then the prices of that stuff will come down. But if they don't let us do that, then we're going to have to get used to the elevated prices. Yeah, we might have a soft landing, but the prices are going to remain elevated.
That's not going to stop companies from citing that in their earnings prints, though, right? We already had Amazon talking about softening consumers, Sherwin-Williams this morning, the choppy environment.
Right. They're suggesting that it's a softening consumer, but you know, when you really look at some of the retail sales, look at that data last week. It was stronger than they expected.
So then how do you separate the winners from the losers?
Isn't that's the $1 million question, right? So you can't, you talk in terms of investing. So you can't necessarily go out and just blanket buy a passive. I mean, I get you can, but if you're really trying to be strategic about it, you really have to pay attention, and you got to listen to what the forward guidance is and who's giving the upbeat guidance, who's giving what they think is more realistic. Even if it's a softer guidance, it's got to be more realistic. So you kind of have to do your homework. You have to listen to what they say. You have to understand the sector you're in. And where you're looking to put that money to work. But I think there's still a lot of opportunity out there, but I'd like to see the market pull back.
So talk to us a little bit more about that specific opportunity. I know you mentioned the second derivative players when it comes to AI, but some of these chip names that we have seen reports so far, you had TSMC last week, then you also compared that to ASML. What does that tell us just about that bifurcation?
So now listen, that's a very interesting deal because ASML, which by the way is the largest European tech name, the largest, they have basically a monopoly on lithography production of the chips, right? They own that space. So they came out on Monday and they surprised the markets with, they missed on their estimates and they gave reduced forward guidance or cautious forward guidance. And you saw what they did to the stock. They took 22% out of the stock in 2 days, partly because investors don't like to be surprised. If ASML knew they were going to miss it, had they forewarned, investors would have been disappointed. They would have taken some out of the stock. But the fact that they got hit upside the head on earnings day, right, is I think caused an overreaction. But look, ASML is not going anywhere. And then Taiwan Semi comes out and reports explosive numbers on Thursday. And guess what? They're ASML's biggest customer. So there's a disconnect somewhere, right? ASML sees weakness, but TSMC says the demand is so great, it's unbelievable. So I think the opportunity is ASML. I think they overreacted. I don't think the guidance is as negative as ASML thinks it is. I mean, look at the other names that are coming out. I mean, we'll see next week when all the tech earnings start to come out, right? I did not see SAPs this morning. Was it good or bad?
It was very good. It was showing that just that their transition to AI and what that is ultimately doing for their cloud demand going forward and some of their projections playing into that, which is what you're saying.
Right, exactly. And the other thing I think you have to think about, and it's one of my favorite names and I own it, so just to be clear, is IBM. I think IBM is one of those names. It was big blue. Everyone looked at it as like kind of this old stodgy stock. I think it's reinvented itself in the cloud space. It's making great moves. I can't wait. I think they announced tonight, actually. Their earnings are out after the bell, I think tonight. But it's been a great performer this year. And guess what? They pay a nice dividend for owning them. So you're getting two things there.
Certainly are. We're going to be speaking with Arvind Krishna. I will be speaking with him, the CEO of IBM, at our Invest conference coming up next month. So we look forward to that. Kenny Polcari, always great to have you. Thanks so much for joining us.
It is always a pleasure to be here. Thank you very much.
Let's switch gears here and talk about small caps. The Russell 2000 pulling back today following its recent rally. But still, our next guest saying that now could be a good time to invest in small and mid-cap stocks. Joining us now, we want to bring in Erica Maschmeyer. She's a Columbia Threadneedle's investment portfolio manager. Erica, let's talk about where you're seeing some of that opportunity, because there has been lots of optimism, and we've seen it play out just a bit following that 50 basis point cut here from the Fed. But more specifically, why do you see this run up that we had seen, or maybe more optimism surrounding small caps? Why is that argument here to stay?
I think there are several factors around it, and most of them are really leaning in favor of small caps. I mean, first, you've got a good economy, right? And I think that needs to be in place for small caps to outperform. On top of that, you've had this backdrop of attractive valuations relative to where they've historically traded, and especially compare that to large caps, which are not attractive versus history. You've got rates coming down. We can argue the pace, but they are coming down. And you also have this scenario where the mega cap stocks, they've outperformed because their earnings have outperformed. It seems like we might be running out of catalysts there. And then the final factor that is a thing in the market is there's FOMO, right? And sentiment shifts. And I think the second you have small and mid cap stocks start to do better, there's FOMO. People don't want to be left behind. And I think that helps drive them even further, especially when you've got this backdrop of a risk on market.
Erica, it's a fascinating point because I wonder how much the same is true for large caps. It feels like the people who are overextended into big tech want to believe this idea of the rotation, but oops, we can't actually get out of large cap tech because then we might miss it. So what are you seeing in terms of the flows into some of those mid cap names that supports the idea of that rotation really becoming fruitful?
We have seen some substantial spikes in some smaller cap names, especially more on the micro cap side. So we run a strategy called the Acorn Fund, and it's a SMID fund, so we really own small caps and mid caps. And recently we have seen more of a rebound in some of these micro caps that had felt more left behind. And Portillo's restaurant is one that's up 30% over the last few months on not really a different change or a change in the fundamentals. But I think that maybe people are trying to have their cake and eat it too. The percentage of assets that are actually invested in small caps are pretty small right now. So I don't think you need big flows to drive big moves for some of these names.
Erica, the driving force then of some of these sustainable returns, is it all about earnings, or what are some of the other factors that investors need to keep in mind?
It is a story of earnings and valuation as well. I think with some of these smaller cap names, you haven't seen a change in the earnings trajectory per se, but the valuations had gotten to levels where they were so depressed. And frankly, just no change in earnings is good news. But on the other hand, you do have, with rates coming down, there are several ways that can fundamentally change the reality for smaller cap stocks. Those are names that do tend to have more floating versus fixed rate debt, maybe haven't been able to lock in a steady low rate for the next 10 years. So, it can help them in that way, which should help to drive capital spending again. Yeah. You also have just a lot of companies waiting for lower cost of capital to start some projects. And I think once we start to see that pick up, I think after the election, that should start to pick up somewhat. Like that should be especially good for a lot of these small cap names, particularly around the construction space. And then also too, just the impact of the housing market. There are big swaths of smaller names that have housing exposure, and we've seen existing home turnover be very, very muted.
Erica, we're back to the no landing question mark being out there over the past week here, and that's certainly contributing to the rally we're seeing in bonds. We've got better than expected economic data. Why go into interest rate sensitive stocks given that backdrop?
I think we've got a solid economy, right? You've got a solid economy of 4.2% unemployment rate, and the path for rates is down. So I think that frankly, this is a scenario where you can have your cake and eat it too a bit.
All right. Well, I'm sure investors love to hear that. Erica, thank you so much. Really appreciate you joining us. Erica Moschmeyer, Columbia Threadneedle Investments Portfolio Manager. Coming up, we are taking a look at some trending tickers, a potential breakup for Cheesecake Factory. We also have strong demand for Homebuilders. Stick around for that next, right here on Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. That's with Yahoo Finance's trending tickers page. First up, let's take a look at Cheesecake Factory. Activist investor JCP Investment Management has taken a roughly 2% stake in the restaurant chain. That's according to the Wall Street Journal. Now, the investor is reportedly urging the restaurant operator to spin off 3 of its smaller brands into a separate public company. You are seeing not too much of a reaction actually right now, with shares up just about 0.7%. But again, making the argument that the company would benefit from some sort of spinoff here going forward. If they were to do that, they see the most valuable or the strategy that makes the most sense is doing that with the smaller brands, and they see that as viable. They do not agree with some of the urgency. This is Citi coming in, some of their quick reaction to this. But again, there does seem to be some consensus on the street that maybe this strategy could potentially make sense in the longer term here for Cheesecake Factory. Maddie.
This was news to me about the other companies that they own, which is just because we don't cover Cheesecake Factory very often. So I will definitely look into the business a little bit more here. But interesting, given that they've got these other brands, and there's a question about whether or not they should sell them off, according to this activist investor. Of course, the pushback, like you said, Shauna, being that that would potentially not be the best move for the company here. What I find interesting about Cheesecake Factory, I always think about this. An analyst I talked to a couple years ago told me that he liked Cheesecake Factory because the portion sizes are so big that they've got good margin control. They could always just cut back on the portion sizes to fight inflation. So maybe we'll see the activist investors talk about that a little bit too. You can see the stock there up 38%.
And it is interesting when you take note of the smaller brands, because I actually had to look them up this morning as well, as North Italia and Flower Child. And mainly the Citi making the argument that they are fully integrated within Cheesecake's business, and there are some synergies there. So I think there's some discrepancy or some disagreement, maybe longer term, with the timeline of this or the urgency in which this needs to play out. And that's also something that was mentioned by Nick Setyan in his note, his quick reaction there from Wedbush this morning.
All right, well, next up, Pulte Group is beating third quarter profit estimates as lower mortgage rates bring more home buyers into the market, boosting demand for new home construction. The Homebuilders' third quarter sales were up 12% year over year, but you can see a big reaction here on the stock, down over 5.5%. And that is because they talked about buyer incentives and a shakiness in the housing market moving forward. This is exactly what the Federal Reserve is concerned about, right? Whether or not bringing rates down could actually still continue to be a headwind for markets, if for the housing market in particular, if home prices continue to kind of calibrate in the opposite direction as mortgage rates. And that's exactly what the home builder here was talking about, increasing incentives sequentially in the third quarter due to market conditions. That could potentially be a headwind for them moving forward.
It could be a huge headwind for them going forward, and I think that's why we're looking at shares off just about 5%. And it's hard to figure out what exactly is going out or how the housing market is going to play out over the next several quarters, let alone the next several years. Because yes, we did see the 50 basis point reduction there from the Fed. Much of that had already been priced into mortgage rates, and you take into account the demand versus supply. It's still a huge supply issue. It seems like in many parts of the country, some of that demand is still there, obviously paling in comparison to what we saw during the height of the pandemic, but there still is a lot of competition for the housing that is available. So of course that is where home builders come in, but you take a look at rates still high on a historical basis. These home builders are having to pay lofty prices just in order to get the homes built. So that's where they are a little bit strapped for cash, and where we are seeing that weigh on their margins here going forward. And that's, I think, also just adding to the uncertainty and what exactly is going to happen to the housing market going forward, given the fact that this shortage of homes, it is a critical issue, it's a crucial issue, but again, just the ability of homeowners to address that and how realistic that is.
And now we have a concern out there about whether or not the Fed is going to cut moving forward. Kenny just said he thinks we're going to have a no-cut November. What does that do to the home builders moving forward here?
Very good point. All right, let's take a look at GE Aerospace, topping third quarter expectations, raising its full year profit outlook, driven by strong demand. Joining us now, we want to bring in Tony Bancroft. He's Gabelli Fund's portfolio manager covering aerospace and defense. And Tony, I just read a lot of reasons maybe to be optimistic about these results, yet we had the stock price up there. You see shares under a pretty decent amount of pressure here this morning. Is this more of a sell the news event, or what do you think is going on here?
Yeah, I think it's maybe being a little bit of profit taking, might be a little bit, they're a little overcharged on selling here. The reality is that GE has a great backlog. It's got great secular tailwinds. They're just capacity constrained, right? There's only so much they can build and wait for Boeing to continue their production with the strike the strike vote on Wednesday. I think the big picture is the GE is a great company. It did very well. It's very strong profitability, free cash flow, a lot of free cash flow, and a huge backlog. And their aftermarket business, which is actually more profitable, is doing better. And in the long term, that's gonna be a real big benefit to the company.
Since you mentioned Boeing, I do want to hop over there. I'm curious from your perspective what you're thinking we are going to get from those results here and whether or not the results could potentially outweigh whatever news we get in terms of any potential deal with the union.
Yeah, well, thanks, Madison. I think, obviously the vote's going to be coming, the results of the vote are going to come after the earnings, obviously, on Wednesday. Obviously, everyone's going to have bated breath waiting for that, and looking to see, what comes out of this vote. I think, it's again a near term. It might be a lot of volatility there, but in the long term, same applies to the commercial aerospace business. Boeing's going to be a huge beneficiary of it. They've got a decade-long backlog. They're still a long way off to be building at rate. So there's a lot of growth in 25, 26. We're going to probably start seeing a lot of that. I think in the near term, maybe the vote doesn't happen tomorrow. Maybe it does, and they still got to get to a 38 rate. The defense business needs a lot of work, but in the long term, they're going to do very well.
Tony, what do you think those realistic growth rates look like then a couple of years out for Boeing?
Yeah, I mean, I have it as I'm keeping the 737 MAX, essentially not getting to 38 a month until, well into next year. But, they will improve their process. The supply chain is going to incrementally improve, and they're going to start building at eventually. They'll eventually get back to that 50 a month. They were at 52 prior to the mishaps in 2018 and 19. So they can obviously do that. I mean, it's fully capacitized for 84 jets a month, but they probably won't ever get to that. But it's doable, and they've done it before, and they're going to do it again.
Switching gears a little bit, I want to talk about a bit of a mixed picture that we were getting here. We had Lockheed Martin results. We also have RTX, Lockheed missing on quarterly revenue estimates only for the second time in the last couple of years here. But RTX raising its 2024 forecast and having it better than expected results. Still seeing both companies under pressure, Lockheed certainly more so. But what do you make of the kind of mixed picture between those two names?
Again, I think big picture, the world's not a less safe place, and it's probably going to be, unfortunately, continue to be that way for the foreseeable future. They're both big positions in our Gabelli Commercial Aerospace and Defense ETF, GCAD, and I like the long-term secular, the secular thesis, the tailwinds for both companies. The defense business is probably going to be it's going to have huge backlogs for the foreseeable future. They have an international business which they both are involved in, which is a higher profitability, higher margin business. And that's going to probably continue to grow as NATO looks to spend and get back to their 2% GDP target, which they're still below as a whole. And in the U.S., again, historically, we're well below our defense spending as a percent of GDP, around 3.8%, historically in the 6%. And, China is not going anywhere, North Korea is not going anywhere, Iran is not going anywhere, and we have two kinetic wars that we're supporting in Ukraine and in the Middle East. So I think unfortunately, there's a lot of work to be done for those two companies.
Certainly a lot of potential headwinds to look at moving forward. Tony, thanks so much for joining us this morning. Appreciate it.
Great. Thanks so much.
Coming up, an interview with IMF's chief economist. Stick around for that next, right here on Catalyst.
Welcome back to Yahoo Finance Live from the IMF World Bank fall meetings in Washington. I'm Jennifer Schonberger. The IMF out with a brand new outlook for the global economy this morning. And for more on that, I'm here with IMF Chief Economist Pierre-Olivier Grinches. Pierre, thanks so much for joining me. It's great to see you.
Thank you, Jennifer.
You see the global economy on track for a soft landing this year into next, but the outlook for growth is tepid and uncertain, you say in the report. Would it take much, for instance, changes in government policies, given that half the globe is headed to the ballot box this year, to knock global growth off course?
Well, there are a number of things that can be done, but let me start with just the broad picture here. So first, the good news. Inflation is almost back to central bank targets in many countries, and we've done this without a global slowdown or a global recession. Growth is, yes, we could do maybe more, but at 3.2% this year compared to 3.3% last year, and we project 3.2% next year, it's quite resilient. So we should celebrate this as, good news. Now, once we're there, then we can think about what to do next. And what to do next, we call for a triple pivot in our report. We're saying, okay, well, now that inflation is almost back to central bank targets, monetary policy can start looking at activity and maybe less be narrowly focused on inflation. Start looking at what's happening in labor markets, which, we've seen some increase in unemployment rates. Nothing that is too alarming yet, but let's be careful. So let's look at that, start cutting rates. That's pivot number one. Pivot number two, there is a need to rebuild fiscal buffers. Why? Well, because debt levels are elevated, growth is not as high as it used to be, and interest rates remain high. So for a number of countries, this is not a comfortable situation. They need to bring debt levels down. They need to improve their primary balances, their deficits, broadly speaking. Pivot number three, growth. Yes, how do we move from that 3.2%? We need to do more. And on this, in our report, we flag a couple of things that can be done. So for instance, one of the big slowdowns we've seen over the last few years in terms of growth is the fact that China is not running, growth rates at 7-10% anymore. It's about 4.8% for 2024, projecting 4.5% next year. And some of it is due to decline in consumer confidence, corporate confidence, and the problems in the property sector. Addressing that would potentially give a boost to the Chinese growth potential, and that would be good for the global economy. Second, when we look at productivity has been relatively tepid in many parts of the world. The US is a bit of an exception. If you look at the euro area, a lot more can be done. So the Europeans are aware of this. There was a recent report, so-called Draghi report, very good diagnosis of what some of the problems are. That requires public investment, that requires investing in innovation, in completing the common market. If they do that, potential growth in Europe could actually increase, and that would also be good for the global economy.
In terms of risks to the outlook in government policies, we are seeing more tariffs across the globe. Europe slapped tariffs on Chinese EVs. We saw the Biden administration take similar action earlier this year. And Donald Trump has pledged to impose tariffs on all U.S. imports. If we were to see that plan implemented and retaliation, what type of impact are we talking about on global growth, as well as the global trading system? Would we see a reordering? Would we see supply chain shocks?
Well, so we've actually flagged this as one of the concerns we have. There are potentially things that could improve growth. There are a number of things that could also weigh down on growth in 2025 and beyond. And one of them is we're seeing this rise in geoeconomic fragmentation, the rise in trade tensions, countries imposing measures that are distorting trade. There are upwards of 3,000 of them now compared to only 1,000 in 2019. And 2019 was not a low point. So we're seeing that movie is being played right now. And so we did a scenario analysis in our report, and we said, okay, well, what if the major blocs start having higher tariffs against each other? And not only that, but that also increases what we call trade policy uncertainty. It's not just that you have tariffs, it's that you don't know what's going to happen next. There could be retaliation, there could be additional measures, and that further weighs down on investment and global activity. And you put these two things together, and the impact on the global economy is quite sizable, about 0.5% of global output that would be lost by 2026 if we have this escalation in trade distorting measures, tariffs, etc. So we're certainly concerned about that and concerned that it might hurt everyone.
And what about the impact on global inflation if we were to see this tariff regime implemented? And would this be sort of like a one-time reset? and then we're at a new level, or do we see longer term implications there?
So the picture on inflation is a little bit more nuanced because it depends on how, when you impose tariffs, how the prices are changing in the country that is imposing the tariffs versus on the country that is producing the goods that are being tariffed. And then you have tariffs on your imports, but then the other countries are putting tariffs as well, so your own goods are also being tariffed. So the overall picture on inflation is, it doesn't seem that it's the first order effect. When we look at this, adding tariffs and trade policy uncertainty, what is really happening is that you have this sort of weakening of the global economy, and that weakening of the global economy is the first order effect. Now, in terms of the persistence of the effect, it's certainly the case that we're seeing them in our scenarios. We're extending them until 2029. If we have higher tariffs, that's going to depress output permanently.
And then what does that mean for global interest rates? Do they continue on this downward trajectory?
Well, that will very much depend on how the domestic inflation trajectory will change and how activity might change. You might see some countries, if in some countries the inflation pressures increase because of tariffs, then central banks would have to tighten policy rates. In other countries, you might see the opposite. You might see a weakening of economic activity, and you might not see that much price pressures. And in that situation, central banks would respond somewhat differently.
I want to ask you about the outlook for global debt. We are seeing, you said the outlook for global growth over the medium term is, quote, lackluster. We are seeing debt payments accumulate. In fact, I have here in my notes that the IMF says government debts are set to match the annual output of the global economy by the end of this decade. With so much debt, what impact do you expect to see on government bond yields? Could we see those rise higher, and could that put a ceiling on growth?
Well, that's one of the reasons why we emphasize this second pivot I mentioned towards fiscal consolidation. It's really important to do it because of the reason you mentioned, which is that we are seeing very elevated debt levels in many countries. Governments had to spend to protect their economy during the pandemic, and then during the energy crisis that resulted in part from Russia's invasion of Ukraine and the surge in gas prices and oil prices. And so they had to spend. And that is reflected now in higher debt levels. Now, these higher debt levels make them more vulnerable if growth were to slow down, if interest rates were to stay high, or if markets start becoming nervous and then start asking for a risk premium, start asking for a higher interest rate on government debt. And so that's why bringing down debt levels and rebuilding fiscal buffers is so important at this stage. When we look at the data, we do see some of this increase in the compensation that investors are requiring for holding, especially long-term debt. That has been an increase. And even if interest rates, central banks were just continue to cut rates as they've been doing, since September for the Fed, but earlier for others, even if they continue to do so, we could be in a situation where funding costs for governments remain high because of this increase in the risk premium that investors require.
What about the U.S.? Because under both presidential candidates, we see deficits rising, and debt right now is already about 100% of GDP in the U.S. Is there a scenario where you see foreign investors requiring higher yields on government treasuries here in the U.S., or could we see a Japan scenario where Japan carries twice as much debt as the U.S., but they still enjoy low borrowing rates?
Well, so it's certainly the case that investors are already requiring higher rates on U.S. government debt. We are not concerned about the situation getting out of hand. But right now, if you look at the macroeconomic environment, the U.S. economy is above its potential. The economy is doing really well. And in fact, the central bank, the Federal Reserve, still has interest rates that are high because it's trying to cool it off and bring it down on this smooth landing path. In that context, having an expansionary fiscal policy, that would be something that could potentially derail the disinflation path. It would add to growth, but it would add to inflation. It would require that the Federal Reserve come in and do more. So this is certainly not something that would be desirable in the current environment, given the trajectory that the U.S. economy needs to be on, which is that it needs to come back to potential output and inflation pressures are gone. So even from a cyclical perspective, we would say this is not something that is desirable. Then for a more long-term perspective, when you get debt levels that are very elevated, the question is, are you somehow vulnerable that the markets might reprice this? We don't think this is a serious risk right now for the U.S. at all, but certainly it would be even safer to have debt levels that are not as high as where they are right now.
Pierre, we'll have to leave the conversation there, but thank you so much, as always, for your insights. So appreciate it.
Thank you.
That's Pierre-Olivier Grinches, Chief Economist of the IMF. We'll be right back after this.
have been aggressive with buybacks. Our multiple hasn't moved. Understand some of the pessimism that's been out there in the market given the past cycles, but hopefully our consistent results quarter after quarter and year after year are beginning to convince those investors on the margin that this is a good long-term play.
That was GM CFO Paul Jacobson speaking with our executive editor Brian Sozzi earlier this morning after the company's results came out, beating expectations in the third quarter and lifting its full year guidance. Joining us now with his reaction to the report, we've got John Murphy. He's a managing director over at Bank of America. John, it's great to have you. I want to circle into GM's ability to cut costs in the U.S. to kick off the conversation. What do you attribute that to?
I think it's a long-dated plan. I mean, by this year, they'll be completing a cost-cutting plan of $2 billion. So I think there's the cost-cutting side, which has been pretty successful. But I would couple that also with a focus on the right product and the right mix, which is helping pricing as well. So there's a combination of great execution from a cost perspective, but also great execution from a product portfolio and pricing perspective that are creating these very large margins, near record margins right now.
John, when it comes to some of that, should there be any concern around the fact that they did warn that pricing could be a bit softer next year, or the fact that that could potentially be an outcome? Just their ability then to offset that with cost-cutting measures elsewhere.
Yeah, no, it's pricing is the billion-dollar question for GM and for the industry at large right now. I think what you're seeing is a pretty good management of short-term inventory on dealer lots by GM. Ford, it's not quite as tight, but it's reasonably good. And Stellantis is where there's a little bit of an issue in the industry. The rest of the industry is actually relatively tight on inventory. So short term, I think we're not too bad off on inventory. I think the thing that gets missed often in the industry is that the late model supply of vehicles on the road in the United States is very short, and we need to rebuild that. Until we rebuild that, the real pricing pressure in the industry is likely not to ensue. So I think that would be a kind of event that would be late 25 or early 26 if the U.S. new vehicle sales rate starts getting to 16 million units plus, and we rebuild that late model fleet, because that really is the substitute product of new vehicles. So I think we actually probably have more clear air on pricing than people realize, at least through the end of next year. Now, there'll be some negative mix for sure. You're not going to continue to sell as many large trucks and luxury vehicles as the SAAR increases or sales increase. But I think pricing itself is probably far better off than people realize or fearing.
It seems like there was a lot of resilience across the report then, John, because the other thing I wanted to get your thoughts on is their ability to kind of survive some of the weakness in China, which certainly some of the other automakers have not been able to say the same thing about. What do you make of that? What are they doing differently?
Well, I mean, they're still losing money in China. So, I mean, I wouldn't say it's a great picture. I think it's something that needs to get addressed with their largest JV partner, SAIC. And ultimately, I do think it's going to be very difficult for the international manufacturers, even with JV partners, compete with the growing number of domestic manufacturers in China. And that's going to continue to be a problem for us quite some time to come. So I think the reality is GM needs to shrink dramatically, or probably even exit the China market sooner rather than later, to really stem these losses. It's quite like what happened in Europe. And Mary Barra, the current CEO, did a great job of exiting Europe in the past, and I think you're probably going to see the same thing happen in the next couple of years in China.
Yeah, John, I was going to ask you the timeline of that, because we know that they are planning a restructuring there. There seemed, though, to be some optimism surrounding potential improvement, though, in China going forward, but it sounds like you're not too optimistic that maybe some of those goals are realistic at this point.
In an industry that's historically lived off of scale, walking away from the largest car and truck market and the planet is kind of a tough thing to do. But the reality is big parts of the market often are areas that you don't make a lot of money in, and you need really to focus on what your core is. And GM's core profit center is North American trucks, and they would be generating at least as much, if not more, EBIT and free cash flow if they just focused on that alone. So ultimately, it's going to be a tough decision. It's a little bit scary to walk away from that kind of scale, but it'll probably ultimately be the right decision.
John, final 30 seconds here. China holds the materials, the means of production for EVs. I wonder, from a policy perspective moving forward, are you worried that China could say, yeah, you can have our materials if you buy our EVs? And what could that do to the automakers moving forward?
It's a very good question, and it's a question that's going to be difficult to answer in 30 seconds, but there is a lot of leverage that the Chinese have built up over the last decade plus in the EV supply chain that the U.S. is going to have to address, not just from a GM perspective, from a national perspective and a national security perspective as well. So that is going to be a long-dated issue, and it is going to be a big point of leverage that Chinese have in any discussions around EVs. And, we'll probably tamp down EV penetration here in the U.S. for the next few years, and probably through the end of the decade, until we rebuild or build our own EV supply chain.
All right, John Murphy, great to get your insight. Thanks so much for hopping on with us, Bank of America's Managing Director. Thank you.
Thanks.
Profit margins will continue to be a key focus for investors when Tesla reports its quarterly results tomorrow. Heavy promotions and discounts have been weighing on the average selling prices of its vehicles, particularly out of China. But plummeting sales of EVs in Europe also weighing on investors and on their stocks as well. Akiko Fujita joining us now to break down the numbers. Hey, Akiko.
Hey there, Shauna. More than 40% of Tesla's revenue still comes from its domestic market in the U.S., but investors are increasingly looking to these key international markets where Tesla faces direct competition from Chinese EV makers like BYD. Tesla doesn't break out the sales numbers by region, but improvements out of China sure to weigh heavily on any stock move coming out of these results. And data from the China Passenger Car Association points to a big rebound for Tesla after a rough start to the year. Sales were up 66% year on year in September, marking the best month of 2024. Deliveries of Model 3 and Model Y vehicles were up slightly from the previous month in September, and that bump coming through after Tesla extended zero interest financing for both models in late September. With that said, Tesla saw a slight dip in market share, down from 4% the previous month to 3.5% in September. Meanwhile, BYD remained in the top spot with a market share of 16.7%. Now, the strength of the Chinese players, certainly not surprising in their home market, but take a look at what we saw over in Europe. Tesla sold just 19,000 cars in the month of August, according to data from JATO. That marked a 44% drop from the same period a year ago. Europe has been seeing a significant drop in demand for battery electric vehicles, with new car registrations down 16% in the most recent month. But Tesla's declines were even more steep, with its most affordable Model 3 seeing a 53% drop in registrations. Meanwhile, you had Chinese EV makers, including BYD and Geely, taking a 15.5% market share on the continent, surpassing Tesla. Now, worth noting that much of that came from sales of Volvo vehicles, which Geely owns, but there are increasing concerns about Tesla's inability to adapt to the reality of the market with a more affordable model at a time when Chinese EV makers are going head-to-head in these markets at a much more competitive price point. Tesla has said plans for new vehicles, a Model Y refresh, as well as more affordable models remain on track to start production in the first half of next year. And with that We Robot event out of the way and largely seen as a disappointment, the attention's going to squarely be on Tesla's core auto business come tomorrow. And guys, sure to get questions as well about the tariffs, especially over in Europe, the impact that's likely to have on Tesla as well.
Yeah, certainly something we've been talking about with lots of analysts. Akiko, thank you so much for breaking that down for us. Appreciate it. Coming up, artificial intelligence companies have skyrocketing valuations. We're going to discuss the sustainability of that money pouring into companies right after this break.
We have hundreds of companies being financed at multi-billion-dollar valuations. Leaders of these companies, I won't mention names, you know who they are, who actually think they're building God in a box. I mean, you can't make this stuff up.
Those comments are made on Yahoo Finance's Opening Bid podcast. Tom Siebel, C3 AI founder, chairman, and CEO, joined Brian Sozzi to discuss the money being poured into AI startups, driving up their valuations with billions of dollars flowing into AI companies. How will they balance profit goals while also mitigating AI risks? To discuss, we want to bring in Navrina Singh, Credo's AI CEO and founder. Navrina, it's great to have you here on Yahoo Finance. Let's start with the sky-high valuations, because I think what a lot of investors, what many of our audience are trying to figure out is how sustainable those valuations are, considering that there are governance concerns just to start there. So what do you make of some of this euphoria that has certainly been playing out and the money being poured into these startups?
Well, thank you so much for having me. You know, certainly if you just look at the data from last quarter, $4 billion was poured into investments in generative AI startups. And we believe that to really get long-term sustainable value, it's not just about the use cases in sales, marketing, drug discovery, but it's really around the foundational principles of AI governance. We are seeing day in and day out, the AI risks are increasing. And also it's really critical for these companies to ensure that they're going to be compliant with emerging regulations. So I think for us right now, what we are excited about is how organizations that are betting early and big on AI governance are really going to show up as winners in the long run.
Navrina, when do you expect to get clarity from a balance sheet perspective on the money that some of these firms are putting into making sure that they can be in line with any regulation that could come down the pipeline here? Obviously, we don't have clarity on that now, but moving forward, how long do you think that's going to take?
You know, one of the things that maybe we need to demystify is most of the organizations we work with, Global 2000s, large enterprises, they are investing in AI governance not just to be regulatory compliant. They are actually investing in AI governance as a foundation of trust. They are finding that if they are able to deliver these AI services with the right governance guardrails, with the transparency at its center, with the understanding of where they're sourcing their data from, they in the long term are able to build that trust. So I do want to highlight it's not just around regulatory compliance, it's about delivering and building that trust with artificial intelligence, which is absolutely critical at this moment.
So Navrina, what is the best way or the right way to go about that? And I bring that up, there's a piece in the Journal right now talking about Meta and some of the other tech peers pushing back on recent EU regulations, saying that their rules are going to threaten to squelch the AI boom, and it's not good for innovation, and it actually, in fact, stifles it. What's your response to an argument like that?
You know, it's interesting. Governance for the longest time has had a really bad rep. It's seen as a speed bump in innovation. And we are strong believers that if you're starting, especially with an emerging technology like artificial intelligence, with the right guardrails in place, what you end up seeing is you end up being the long-term winner. So we are finding in the companies that we are working with, Global 2000s, large enterprises deploying GenAI at scale, that they're actually winning with governance, and it's not stifling innovation. They're seeing new product development. They're able to really take GenAI from a concept into production pretty quickly. But again, we are living in a show me moment. You know, show me what GenAI can do for revenue drivers, and we believe that governance is going to enable that innovation.
All right, Navrina Singh, Credo AI CEO and founder, thanks so much. We appreciate it. We're going to do a quick check on the markets here. If we can pull up the board, we'll see that you've still got red across your screen. The Dow still under pressure. The S&P down about 0.3%. The NASDAQ moving a little bit closer to the flat line, though. Focusing on the broader S&P, you've got energy no longer the biggest gainer of the day. Consumer staples actually the biggest gainer of the day so far. You've got financials, utilities, materials, and industrials all under pressure here. We've also got that bond sell-off continuing If we can flip the board over to the Treasury space, I'll do a quick look at what we're seeing there. Treasury still selling off on the heels of this expectation from central banks globally that we may be slowing down on the rate cutting cycle. And you can see those treasuries on your screen right now, Shauna.
All right, coming up, we've got Wealth that's dedicated to all of your personal finance needs. Ali Canal has you for the next hour. We'll see you tomorrow.
Welcome to Wealth. I'm Alexandra Canal in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, I'm speaking to a portfolio manager about the top investment themes to watch through year end. Plus, he gives us a few ideas for underrated stocks you may want to consider adding to your portfolio. And risk on versus risk off. Assets like Bitcoin and gold have rallied this year, but are they making their way into retirement portfolios? We'll find out. Plus, personal finance influencers are all over social media. So how do you know who to trust? I speak to the budgetista herself, Tiffany Aliche, about how to spot misinformation online. But first, we take a look at some of the market action 90 minutes into the trading day. We're seeing stocks retreat for the second session in a row as investors digest a recent bond sell-off and a new crop of earnings. You're seeing that the Dow and the S&P are both leading those declines there. Each index is down about 0.3%. NASDAQ is trading near the flat line, but still in the red there. The moves come as investors reassess the future of Federal Reserve rate cuts. Joining me now to discuss is Bryant Van Krake, Allspring Global Investment Investments Senior Portfolio Manager. And Brian, it's really interesting to see this shift in expectations, right? Now, a higher for longer narrative at play here. And this comes despite recent commentary from Fed officials that they'll continue to cut rates, at least in the near term. So what does this all tell us about what investors are thinking about the long-term outlook for markets and what the Fed ultimately decides to do?
Yeah, all eyes remain on the Fed right now, even though we're entering a very important earnings season. But from a macro level, the Fed still controls the direction and the level of markets. And there's two things to think about. One, in the short term, where are we going with inflation expectations and what's happening with the labor market? Is supply demand truly in balance, allowing the Fed to have optimism that inflation is coming lower and they continue on this rate cutting path? My view is they probably want to pause here, digest some more data, and not be bullied into an additional 50 basis point cut coming up in the next month or two. But longer term, one of the big issues that I'm struggling with is what happens if the Fed loses credibility? Their ability to control inflation or to use policy tools to drive inflation expectations is in part relying on investors and consumers' belief the Fed has visibility, has this unique knowledge. And if all of a sudden the labor data moves the wrong direction after this recent cut, or the inflation data bumps back higher, the market needs to quickly reprice inflation expectations going forward, reprice the bond market with yields moving higher, which will probably lead to an equity market pullback as well. So I'm a little bit worried about Fed credibility as we enter these next few significant data points.
Brian, you mentioned inflation a few times, and it's moderated, but like you suggest, a potential resurgence in price increases, that's a big concern for investors. How do you view the inflation story? And is there a way for investors to position their portfolios to hedge against that possibility?
Yeah, I view it as two issues here. One is supply side issues, which the Fed really can't control, right? We have issues with geopolitics that could lead to commodity price inflation if wars were to expand from where they currently are today. We have issues around labor strikes, which could cause supply issues. That could put upward pressure on prices, and the Fed has very little control of that. There's also the demand side where they have more control. And we have a fiscal situation here where both parties seem to want to spend a lot of money, at least they say they're going to. That's going to put upward pressure on demand. It's going to put upward pressure on prices. And the labor situation is still not fully in balance in my mind. We might have quantity in balance, but maybe quality isn't quite where it needs to be. And so I think there's a two-headed issue here for the Fed to deal with. Part, they can probably help on their own. Part, they're going to have to just accept their reality, but it's a concern. So from an investor standpoint, build a portfolio that's balanced. Don't rely on any macro outcome, whether it's inflation or GDP, but a balanced portfolio with both defensive and offensive holdings within it.
And speaking of having a balanced portfolio, we've seen this recent rotation out of mega cap big tech stocks into other areas of the market, like utilities, for example. Do you think there's still more to room to run with that rotation story? And are there other sectors that you're very bullish on at the moment?
I think there's a lot of room to run in this. We've seen growth stocks in general do really well the last 12 to 24 months, and I think with good reason. But starting in Q3, that rotation began. The market has been chasing a small group of stocks, both for exuberant reasons around the AI trade, but also fear reasons. The fear around the Fed making a mistake, causing a recession. And so investors are pushing capital into a very small group of stocks, the ones we all know that dominate the top of the S&P 500. Valuations up there got really expensive in my mind on a relative basis. Now, there's also good reason for that on an earnings front. The Mag 7 in 2024 had earnings growth that was 25% above the growth rate of the rest of the S&P 500. That growth rate shrinks to 5% in 2025. And so investors need to stop and step back and say, am I paying too much for businesses that are great, but ultimately not going to be growing much faster than the broader market? And so what I think should happen is investors will become less greedy about the AI trade. They'll be less fearful about the macroeconomic event eventually. And they're going to rotate into what I think are value stocks. And the value rotation will help support industrials, materials, healthcare, utilities, and even bank stocks.
And speaking of that, you do have some mid-cap names that you like. You say those are underrated. What are those stocks? And what's the benefit of going for a mid-cap name versus a mega-cap stock like an NVIDIA?
Yeah, mid-cap stocks and mid-cap companies tend to be in the sweet spot of their life cycle, right? We have a lot of challenges as infants, whether it's humans or as companies, getting through the riskiest phase. A lot of upside, but a lot of challenges. Once you become a big company, it's really hard to move the needle from things you control. There's only a small subset of companies up cap that really have that ability. In the middle of our life cycles, when we have the most ability to control our destiny with the least amount of relative risk. And so mid-caps tend to do quite well. Today, we want to own our companies that have the ability to have secular drivers and elements that they can control that are maybe being overlooked due to cyclical issues. So one example is in the packaging space. Graphic Packaging is a company that's moving up the quality scale when it comes to their cash flow stability and predictability. They've sold off more of a commodity piece businesses. They've invested through CapEx and R&D in areas that will allow them to, one, lower their cost to manufacture, to be the lowest cost provider in their entire market. And two, the R&D gives them unique innovation that drives pricing power. The result of this will be a more stable, predictable, higher quality cash flow stream with better margins, and ultimately the ability to use their own capital then to give it back to us as investors through buybacks or even to grow through future acquisitions. I think that's mispriced today in their stock.
Brian Van Krake, Allspring Global Investment Senior Portfolio Manager. Thanks so much for your insights today.
Pleasure.
Nearly 50% of Gen Z and millennials would like to incorporate crypto investing into their 401k accounts. That's according to a new Charles Schwab study. But how exactly are those riskier assets impacting early retirement strategies? Here to discuss, we have Wayne Park. He's the CEO of John Hancock Retirement. And Wayne, look, retirement approaches different for everyone at every age. But how are your clients viewing some of those risk-on versus risk-off strategies?
Yeah, thank you for having me. I think, as you said, retirement investors in their 401ks are different than your professional investors. So I don't think they think of it in terms of risk on or off. But what we have seen from our research is that their willingness to take on more risk, regardless of generation, boomers, Gen X, and of course millennials and Gen Zs, but it's more because they feel like they're falling behind in their saving for retirement. So that's really the genesis and driver for willingness to take on more risk.
And what does that look like? What does more risk? How would you describe that?
More risk is willingness to take on probably past their traditional age allocation of having more equities in their portfolios. I know you talked about the crypto and whatnot. There's a barrier actually in your 401ks to do that first, probably than other investment accounts, which is you have to have your employer make them available for you. So while there's intent and desire to invest and take on more risk because they do want to get more return because they do feel like they're falling behind, one of the challenges in a retirement construct is to make sure that your employer makes them available to you.
And let's talk about the less risky moves, especially because that seems to be the older you get, that's sort of the once, right, for investors. So what do those look like?
Lesky, I mean, honestly, it does go back to the foundation. Target date funds in the retirement construct, 401ks have proven to be very successful. So making sure that you're keeping track and being engaged in your investment product, especially in that time period, 5 to 10 years before you think you're going to retire. Because the other surprising thing that we learned from our research is that those that have retired learned 60%, more than 60%, retired earlier than they thought they would. So making sure that in that 5 to 10 year kind of red zone period that they're really paying attention to what they may need in retirement would be a really good idea.
And you've been doing this for a long time. How have you seen things change over the years? And especially as we enter this period of TBD, right, with the election, what the Fed is going to do. Should you reallocate your holdings in anticipation for that, or is it better to just stay the course?
I'm a big believer in staying true to stating the course and making sure that it makes sense for you personally. Plenty of research shows that in every election, regardless of which party win or which candidate may win, the long-term effects are not that different. So it's important to go back to the foundations, make sure you understand your personal situation. So stay the course for sure, but what we have seen actually is things like inflation do matter. It is impacting the generations differently. And for your personal situation, talking to a financial advisor or any investment professional like John Hancock Retirement or anybody that may be available to your employer is really a good idea so that you're not doing it on your own, and also having an objective party look at your situation is always helpful.
And to that point, John Hancock is out with a new report on retirement preparedness and found that most respondents feel behind.
Yes.
Why is that the case, and what can you do now to prevent that?
I think for the younger generation, certainly millennials, Gen Z, and Gen X, they feel really behind for a couple of reasons. One is inflation. It's taking an impact, and we see it in terms of flows and people taking money out of the retirement plans. Number two, especially for Gen X, is the number of different priorities that you have to deal with. Saving for your own retirement, saving for your children's college, you may have a mortgage, and you may even have your own student debt left over. So I think the strain of trying to meet all these different objectives is playing a role in feeling behind for retirement because I think most people feel like retirement is further away. Boomers, though, we've learned that they are most confident and probably on the better off situation because most of them have seen what that looks like and have access to financial professionals that can access for help.
Life expectancies have also increased, right? So what's the new target retirement age? And you mentioned that there's opportunity to retire early. So is there steps you could take to really ensure that you can maybe meet that mark and retire earlier than expected?
Yeah, I mean, this is really great news that people are living longer, right? So the average life expectancy is about 80 now. So really great news, but what comes with that good news is the ability to fund that retirement for a longer period of time. So I think that reality is striking for people to say, hey, I think I'm going to live longer. Hopefully it's longer, healthier. But at the same time, if I'm saving for 80 years, right, and 20 and saving for decades of retirement versus a few years, it has a very different formula. So I think that's when the willingness to take on more risk comes about. And we can help, right? I mean, the number one thing for people to think about when they are thinking about living longer is not doing it alone, access to a financial advisor, companies like John Hancock, but it's a combination of thinking about living longer and the current worry about inflation and economic conditions that I think are really coming through our study.
An important topic. Wayne Park, John Hancock Retirement CEO, thank you so much for joining us today and in studio. Appreciate it.
Thank you.
Coming up, home improvement projects, big and small, are expected to pick up in the next year. We'll tell you how to pay for it without breaking your budget. That's next on Wealth. Mortgage rates have come down substantially from the highs seen in October 2023. And as the Fed continues its easing cycle, mortgage rates are expected to come down even further. Economists expect this trend to spur not only the housing market, but the remodeling and renovations market as well. Annual spending is expected to hit $477 billion by this time next year. That's according to a new remodeling activity report from Harvard University. Here are some tips to renovate your space on a budget is our very own Rochelle Okufo. So Rochelle, what should folks be considering here?
Well, Ali, as we keep in mind that domino effect of falling mortgage and interest rates, that means more consumers are thinking about getting their homes ready for sale, or they really want to splash out on some upgrades. So with all that equity that's been building in these homes since before the pandemic, it's tempting to tap into it for renovations. For major repairs, though, like remodeling your kitchen or bathroom, typically consumers use a home equity loan or home equity line of credit, your HELOC. Now, these offer lower interest rates than personal loans and credit cards, and some of these improvements are tax deductible. But this does mean that you're using your home as collateral. So please don't take the risk if there's a chance that you can't keep up with the repayments. And that's also a reason why good credit is required for those loans. And what about other options? You also have energy efficient improvement grants. Low income households can apply to the U.S. Energy Department's Weatherization Assistance Program. There's also FHA 203K loans via the U.S. Department of Housing and Urban Development, or HUD. Now, this allows home buyers and homeowners to finance up to $35,000 of their mortgage to repair, improve, or upgrade their home. And what about elderly homeowners? Well, those in rural areas can use the U.S. Department of Agriculture's Section 504 Home Repair Program for grants of up to $10,000 and low-interest loans of up to $40,000, but it's for critical repairs only, Ali.
So, Rochelle, for people who just want to refresh their homes versus a full-blown renovation, what's the best options that are out there right now?
So it depends on how you look at it. So first you have your usual retailers, your Home Depot and your Lowe's, but you really get the very best discounts there if you have a commercial or business account. But in some cases, it still may be worth shelling out that little bit of extra with them for projects, especially those involving curb appeal. Now, according to trade publication Remodeling, the top 3 renovations that give you the best return on your investment are replacing your garage doors, your front doors, and switching out vinyl siding for stone veneer. Now, you can also check out big box stores like Target. Now, the retailer announced it's cutting prices on more than 2,000 items this holiday season to ease some of the strain on consumers. Now, if you remember, Target ran a similar campaign in May for summer savings when it cut prices on more than 5,000 items. So if it's sprucing up, a few things in the window and a nice mat, really get that curb appeal going, that's still going to add some value to your house there, Ali.
Got it, Rochelle. Thank you so much for those tips. Appreciate it, Rochelle Okufo. Thanks so much. The IRS announcing new federal income tax brackets for 2025 to adjust for inflation. The brackets help determine how much of your taxable income, which is your gross income subtracted by your itemized deductions, you owe the government. The top tax rate stays at 37% for individuals who make more than $626,000 or over $751,600 for married couples filing jointly. The bottom tax bracket is 10% for people who make around $12,000 or less, and married couples filing jointly who make around $24,000 or less. And that's not all. The standard deduction, which is a dollar amount a taxpayer can subtract from their adjusted gross income to reduce their taxable income, is rising too. It's now $30,000 for married couples. That's up about $800 compared to 2024. And single filers can claim $15,000. That's up from $14,600. Coming up, I'm going to give you my wealth tip of the day, one thing to watch to help you better build your financial footprint. That's next. It's time for our wealth tip of the day, hedging against short-term volatility. With the presidential election just 2 weeks away, here's how the stock market is accounting for potential disruption and how you can take advantage. Now, as a reminder here, long-term investors should try not to make too many moves since historically, elections do not change the trajectory of stocks, which we'll dig into in a minute, but we have seen some recent changes as investors prepare for either a Harris or Trump administration. I want to kick things off with a little sector action since utilities and financials have both ripped higher since the start of the year. You're seeing that utilities are up nearly 30% since the beginning of 2024. Now, some of this has to do with the artificial intelligence trade and the energy demand related to that AI boom, but utilities is also a defensive play and typically does well no matter who is in office. The same can be said for financials. They're also up 25% since the beginning of 2024. Financials have reported strong earnings under the current Democratic administration. So if Harris were to be elected, that status quo would likely continue and bode well for the sector. Conversely, a Trump administration could be deregulatory for banks. So either way, good news for financials. I also want to take a look at stocks versus bonds here. And I hit the wrong thing, but here we go. There we go. Stocks versus bonds. We've seen stocks outperform bonds significantly, especially in recent weeks, with the 10-year Treasury yield trading around 4.2%. This comes as traders bet on a higher for longer policy shift from the Federal Reserve, given the strong growth of the U.S. economy, coupled with strong employment. But inflation remains a risk under both administrations. Economists have also said that a possible Trump presidency could lead to higher inflation over time due to his proposed tax cuts and push for more tariffs that would force a higher interest rate policy from the Fed. But while we're talking hedging, we should look no further than gold. The precious metal has been on an absolute tear amid all of these uncertainties, not just the presidential election, but also the conflict in the Middle East. Gold, which has hit multi-year record highs, is often referred to as a safe haven asset. So it's no surprise that we're seeing gold pretty much pace with the S&P 500. Finally, I mentioned how long-term investors don't need to be too concerned here since stocks normally go up. And if we take a look at the S&P over the past 10 years, that index is up more than 200% despite the various changes at the government level. Yes, there's been short-term blips as we've seen. However, if you are able to really weather that storm, the markets have remained incredibly resilient there. So something to look out for as we enter these periods of uncertainty, these periods of volatility. Just remember this chart that over the past 10 years, you could have seen a return of more than 200%. We'll be right back on Wealth, more after the break.
Welcome to Decoding Retirement, where we go behind the scenes and behind the headlines to help you plan for and live better in retirement. Hi, I'm your host, Bob Powell, and today I'm talking about a headline that's been in the news for a long time, and my guest is Ann Ackerley, Senior Advisor at BlackRock. Ann, welcome.
Thank you for having me.
Oh, it's a pleasure. I've learned much about your career over the years. As like you, I eat, breathe, and sleep all things retirement. So
I do.
I'm looking forward to a fruitful discussion. But before we talk about the state of retirement, I want to do a little bit of table setting. The Employee Benefit Research Institute Retirement Confidence Survey notes that just 21% of respondents are very confident in their ability to have enough money to live comfortably throughout retirement. The work that you've done at the Aspen Institute suggests that there are more than 50 million Americans who live in or near a financial crisis. And before we talk about Larry Fink, I want to mention that there are some people who don't think there's a retirement crisis. Andrew Biggs at the American Enterprise Institute says there is no retirement crisis, at least for most Americans. But Larry Fink, your boss over at BlackRock, he, in his annual letter to folks, noted that there are critical challenges that aren't being discussed enough and need urgent focus, that the traditional retirement system is facing new demographic realities, putting a secure and dignified retirement increasingly out of the reach for many people. So what say you about the state of retirement?
Well, Bob, I'm obviously likely to agree with Larry that there are some critical challenges that we need to face. We just did a survey a couple weeks ago where we went out and we asked registered voters whether they thought there was a crisis. And 90% of registered voters say that there is a crisis, a retirement crisis in the U.S. And that is actually true whether you look at Democrats, independents, or Republicans. It's really the same percentage. And so I think we need to listen to people who are saying that they need help. You've cited some statistics. I can just add a couple. The Federal Reserve says, 1 out of 4 Americans has absolutely no retirement savings. Brookings Institute has said that 40% of people will outlive their savings. So I'm not sure, that we need to get into, I know the stuff that people are saying, well, no, some people are doing well. Yes. Obviously, there are some people in the United States that are very well prepared for retirement. But I think we need to focus on the fact that there are a lot of people who are not well prepared. And some of it's because of the trends, right? There are two, I think, big trends that we probably need to think about. One is people are living longer. And so, if you just look over the last century, right, we've added something like 30 years to people's lives. And so, if you used to retire and live to 70 or 75, people today might have a chance to live to 100. That's a very different way of retiring. And the other thing is we've had a big shift, right, from people who used to have pensions. Now, obviously not everybody, but many people had pensions. And today you have a defined contribution system where people are on their own. And so I think what we're seeing is there's been these big shifts and people are asking for help. And I think the industry has done some good things. We have a lot more to do.
So you just reminded me that having that I have the most depressing job in America, which is you're reminding me that we haven't saved enough and that we're going to live too long. So thank you for that reminder. But
there are things you can do.
There are things you can do. So that leads us, I guess, to this notion that in his letter, Larry addressed the role that capital markets can play in helping people address the not saving enough or living too long.
Right. So he talks a lot about capital markets. And obviously, I think getting people to save young and allowing the power of compounding over time is critically important. And Larry talks a lot about, young people being invested in the equity markets and using the power of these markets to help us. I think there are some other things that we would want to talk about. And you mentioned one earlier on, which is, making sure that people have access to the tools that they need. And I think that's part of using the capital markets. So one thing I would just say is, 57 million Americans don't have access to a workplace plan. And yet we know that if you have access, you're 15 to 20 times more likely to save for retirement. I mean, we're all busy. right? If you make it easy and you take it out of my paycheck and I can put it in a plan at work, I'm probably going to save. But we've got a lot of people who work for mostly small and medium-sized businesses, which is a lot of this country, and it's actually almost half of the private sector, don't have access to these plans, and it just makes it harder for them. So I think that's one thing we could focus on.
Right. I mean, Secure Act 2.0 went a little bit toward helping that in terms of giving small businesses credits to put in place a retirement plan.
Yeah, and I'm a big, Secure 2.0 is going to give them tax credits. There have been big changes in technology that make it much easier for people, companies to have online access. It can be a few clicks for the employer, a few clicks for the employee to actually get signed up for 401k plans. So, I think historically companies have said they're expensive and they're hard to administer. And things have happened to try to make it easier for businesses to offer these. So that's one thing. Another thing, just when I think about access, I think about access to simple investment solutions. And what I would call out is, we don't need people to be investment experts to take advantage of the capital markets. Target date funds. They have been really an amazing solution, I think, to people who don't want to do it themselves. So age-based, asset allocated, do it for me, put me in stocks when I'm young, put me in fewer stocks and more bonds when I get near retirement. And I think that has helped a lot of people save for retirement.
So you talked about target date funds, and we've talked about maybe how different younger generations need to save more, perhaps. I look at it anecdotally, and I think when I entered the workforce, there was no 401k plan. They were really just IRAs. But as my children enter the workforce, it's almost impossible for them not to enroll in their 401k. They're automatically enrolled, and they're automatically put into a qualified default investment alternative, typically a target date fund. So sometimes I think for the younger workers who are entering the workforce, the crisis isn't as great because they're starting to save right from the get-go.
I agree. If you work for a company that offers a plan, and that's going to be a lot of large companies. And so, when I think about, I too have two adult children. One is a musician, and he's historically had some non-traditional jobs. He didn't have the benefit of a 401k. My daughter, more traditional jobs, has the benefit. So I think it's a bit of a mixed bag for young people, depending on where they work. But yes, if they're at a company, they're automatically put into it. They're put into the target date. They might even be auto-escalated, meaning every year the percentage of saving goes up. So I think the industry has really worked hard to make it easier for a lot of these young people to save.
Yeah. So you've also talked about this notion of thinking about retirement income the moment you start saving for retirement. For retirement. So what is that about? I mean, it's hard for a 20-year-old to think about retirement income when they've got a 40-year window to save for retirement.
Yeah, and we should acknowledge, particularly for young people, yes, in some ways it's been made easier, but they are facing, they might have student debt. They might be getting to have credit card debt. We've had rent and expenses. So I don't want to make it to say, for, Gen Z in the workforce, it's all so easy. But there have been some great, innovations that have come with it. On income, we do a survey every year. It's called Read on Retirement. This is our 9th year of doing it. We go out and talk to about 4,000 people. And, what we've heard on income is that 60% of everybody we've talked to is afraid of outliving their savings. So yes, actually the Gen Z were the most afraid, which is kind of interesting, but maybe that's because they're going to live the longest. But every generation is very, very worried about this. And so I think where the industry needs to start thinking about is we've done some good things to help people save. And now we need to focus on how we're going to help them in retirement. How are we going to make this pool of money that they've saved into kind of a paycheck that they can get every year for as long as they live. And I would just want to say, we've had the pleasure of being able to talk to Bill Sharp, the Nobel laureate, who has actually called this the toughest, nastiest problem in finance, right? And because you don't know how long you're going to live, you don't know what the markets are going to do, you may not know what your expenses are. And yet in the United States, we've kind of said, hey, everybody, go figure this out on your own. And so I think most people do worry about outliving their savings.
Yeah, I always say that if you could tell me your date of death, I could build you the perfect retirement income plan, I think. But
we all could, right? Because if I'm going to live to 75, I know how to spend my money. If I'm living to 100, I'm going to need to spend it and invest it differently. Right.
And it also reminds me, years ago, the Social Security agency used to have a break-even calculator on their website. Jason Fichtner, who at the time was the assistant administrator of Social Security, told them to take it down because people were misusing it. They were sort of using it as saying, I'm only going to live to 78, so I'll claim early.
Yeah. We work a lot with Jason. He's terrific. He's done so much around income and Social Security. But if I had a piece of advice, to the extent that you can, delaying your Social Security can really help you. Because if you take it at 62, that's going to be kind of your minimum payment. And if you can wait to 70, it's something like a 77% greater payment if you can wait that long.
Right. Not to mention that if you're the higher earning spouse, you'd be leaving behind a higher survivor's benefit for the lower income spouse, which is great. So, my history with BlackRock is that you've been a leader in this notion of turning assets into income. I believe there was a tool called Corey at one point that you created.
There is, yeah.
It's still in existence?
Yes, it is.
All right. So, this whole, this is troubling because people have been taught, I know how to save for retirement. I don't necessarily know how to turn that asset into income. You've been famous for including an income annuity inside the target income funds or target date funds. Tell us more about that and how people can sort of use it.
Sure. So 6 years ago, Larry Fink got a whole group of us together at BlackRock, and he really challenged us and said, we need to do more, particularly around this notion of helping people spend in retirement. And one of the things he challenged us was, could we bring some of the benefits of defined benefit to the defined contribution world? And as you've mentioned, there are these things called annuities, right? It is guaranteed income. They exist, but they have a bad reputation. I mean, I'm not an insurance company, but, people have thought they're complicated. They can be expensive. I don't want to say all annuities, but people have typically not used them.
We have to take time to answer a reader question in a segment that we call Ask Bob. And when we come back, we'll talk more about longevity. The reader asks, what is the difference between a subsidized and an unsubsidized federal loan? The main difference between a subsidized and an unsubsidized federal student loan is who pays the interest while the loan is outstanding. With a subsidized loan, the federal government pays the interest while the student is enrolled at least half-time, during deferment, and during a grace period. This means that the amount borrowed as a freshman is the same amount that needs to be repaid when the student graduates. With an unsubsidized loan, the student is responsible for paying all interest from the time the loan is dispersed until it is paid in full. This means that the balance of the loan increases immediately, and the student should consider making at least the monthly interest payments. Welcome back to Decoding Retirement. I'm talking to Ann Ackerley from BlackRock. And before the break, we were talking about income annuities inside target date funds. And I interrupted you, so feel free to pick up where you left off.
I'll keep going.
Yeah.
So, annuity, what we said at BlackRock was annuities exist, they're guaranteed income. What if we could help people get simple and affordable annuities within their 401k plan? And that's what we've been working on for the last 6 years. We work with some insurance companies that were willing kind of to reinvent annuities and make them simple and easy. We've put it into a target date, and so which people know and are using. And so when you want to retire, if you're in this solution that we have, you have the option to take a portion of your assets and get guaranteed income, get a paycheck for life. And we think that has brought some benefits of, the traditional pension to the 401k space.
Right. And when I think about income in retirement, there are some people that suggest that a very simple way to think about it is to match your guaranteed sources of income with your essential expenses, and then match maybe your discretionary assets with your discretionary expenses, or your risky assets with your discretionary expenses.
And that's exactly how we thought about it. We said that, based on everything we looked at, if people had Social Security and if they took about 30% of their assets and annuitized them, that would probably be able to cover fixed expenses. And then they could take the other 70% that they have within the 401k and invest that, for what we call more flexible income.
Right. So maybe you could also touch on a little bit of the history of income annuities being allowed inside these funds. It took regulatory efforts, I think, for this to be allowed.
Well, what I'd say is that the Secure and Secure 2.0 are looking at this, right? And what they gave some safe harbors to plan sponsors. Appropriately, we work in an industry, this is people's retirement money. We should be incredibly protective of it. And new things, innovations are kind of hard to bring to the 401k space because we need to be really careful about what we do with people's money. So the Secure and Secure 2.0 have said to employers, if you want to put annuities into a 401k plan, so long as you've used certain criteria for picking the insurance companies, you should be okay. So it's trying to encourage employers to really think about income and to include some form of income into the 401k plan.
Yeah. So when I think about retirement, I always think about the risk associated with it and that you need different tools to manage the different risks. With longevity, there are a few other tools other than income annuities that can at least manage and mitigate the risk of outliving your assets. It may not necessarily manage or mitigate the risk of inflation per se, which is why you might need risky assets for that.
That's exactly how we've thought about it, right? If you have an income annuity and you have some guaranteed income, right, you're building some security, some certainty into however long you're going to live. And then you use the remaining assets, right, have it invested in part in the market, in part in equities, which should help you against inflation.
Yeah. How do you recommend that people get their head around what is sometimes described as the annuity puzzle, right? This notion of I'm giving someone money and I may not get it back if I die before life expectancy, let's say.
So the way we looked at it is if somebody's going to give up some money, we thought they would want to start getting payments immediately, right? There are other annuities that you give up your money today and you may not be able to get it till you're 85. We said most people, and I'll include myself in this, if I'm going to give you 30% of my assets, I want my payments to start today. And then we have some features, not too many, because we wanted to keep these simple, that would give you some protections if you passed away earlier than you thought.
Right. And a lot of times people think of income annuities as investments. I think of them as insurance in a sense, in part because they're offering you something called mortality credits. And is that something that you educate people on, or is there a need to educate them about mortality credits?
I think we more talk about just guaranteed income, right? Certainty. Interestingly, in our Read on Retirement survey, 80% of people we talked to said that the thought that they might run out of money in retirement was causing them mental health issues today. And 93% said if we could get some guaranteed income in our 401k, we would feel better. We would have less pressure, less stress. And so I think some of this is just about telling people, you can get some guaranteed income that will help you not outlive your savings.
Right. And I think some of the recent research from people like Michael Finke and others have suggested that having guaranteed sources of income also enables you to spend more now in retirement.
100%. I mean, if you think about it, right, that kind of makes sense. If I know I'm going to get these checks, if I know I'm not going to be able to outlive my money, I might feel better today about spending money. There was a study that Ebree did with BlackRock that showed, 80% of people still had a lot of assets when they were 80 in retirement because people are holding back. And, they're worried about medical expenses and other expenses and outliving their money. And so, I think having some form of secure income within the 401k could really help people feel less stress about it.
Well, I hope people take to heart the messages that you've delivered today. But before we take a break and say goodbye for this moment anyway, let's have a little fun. You're passionate about retirement, as I am, but you have some personal anecdotes to share with us.
Well, I would just tell you a story. When my mom was a high school teacher, she worked for 35 years. She worked extremely hard, as one of 5 kids. When she retired, it was right about the same time I was going over to BlackRock. And she got an annual report from the New York State Teachers Pension Plan that indicated that BlackRock managed some of the money. And so my mom would take the annual report, circle where it said BlackRock was managing the money. She'd put a little yellow sticky on it saying, "Dear Ann, please take care of us old teachers. Love, Mom." And she would mail it to me every year. And I just, as I started at BlackRock, as I started in asset management, and then as I ultimately became the head of retirement, it was a really good reminder to me that every penny we manage at BlackRock is somebody else's money. It's somebody else's hopes and dreams. It's somebody else's retirement. It was my mom's. It was her friends. It was her teachers. And she never let me forget it.
Yeah. So, and before you go, what's the actionable advice you have for folks, whether they're young or old here?
Well, for young people, right, if you can save early, save often, put it in a target date. I think that advice is good for as you get older as well. I would say for people getting close to retirement, if you haven't been able to save as much as you want, can you use your catch-up contributions? I think that's important. We talked about can you delay taking your Social Security benefits? That can help you get more in retirement. And then I'd say for everybody, ask your employer if they're offering guaranteed income within the 401k. I think they need to know that people want it.
Yeah. I'll throw out one last thing. John Chauvin over at Stanford talked about working 2 years longer as one way to improve the possibility of having retirement security.
I'm not going to get into, I think everybody should work as long as they want. Some people never want to retire. Some people will have jobs that they're going to have to retire at a younger age. I think our goal is everybody should be able to retire with dignity when they want.
And I can't thank you enough for sharing your knowledge and wisdom with us. Hopefully you'll come back on the show in the future. Maybe there's another survey that you've done or maybe another product that you've introduced. We'll come back and talk
We're
more
always
about.
trying to make it better, so I would love to come back.
Up next, we'll answer another reader question in a segment that we call Ask Bob. The reader's question goes like this. I have one credit card and I'm making debt payments on time every month. Plus, I'm making sure the amount owed is under 30% of my credit limit. I understand that I might not be able to increase my credit score until the length of my credit history is longer. Is that correct? Well, I went to Christina Roman from Experian to answer this question, and she said that making your payments on time and keeping your balances low are the two most important factors in determining your credit score. However, commonly used scoring models like FICO and VantageScore also take the length of your credit history into consideration. A longer history generally demonstrates to lenders that you have experience managing credit responsibly. Since you only have one credit card, your credit history is relatively short, which can impact your score. If you've got questions about money or retirement, email me at askbob@Yahoo Finance, and we'll do our best to answer your question on a future episode. So that's it for this week's edition of Decoding Retirement, with hope the information that you've learned today will help you plan for and live in retirement a little bit better today than yesterday.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
Let's do a final checks of the markets. We're continuing to see red across the screen amid growing doubts that the Federal Reserve will continue to cut rates aggressively or even possibly hold rates steady in November. We're taking a look at sectors right now. You're seeing energy, consumer staples, and as well as real estate, the only sectors in the green, whereas materials, information technology, and consumer discretionary, the biggest laggards of the day. You're seeing the S&P 500 leading the way lower there, down about 0.2%. The Dow also down around 0.2%, while the Nasdaq, which originally earlier today was trading near the flat line, down about 0.1%. That's it for Wealth. I'm Alexandra Canal. Thank you so much for watching, and stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern.